Okay, section 10, 1H.
And section 10A.
Section 10, 1H and section 10A. I'm going to start with section 10A because this one, it talks about what? If something is on section 10, people, it deals with what? If something's a section says section 10, it deals with what? It deals with exemptions. Yes. So we are still on exemptions here, right? We are still on exemptions. Okay, so let's move and see what is going to be exempt in terms of section 10A. Open your act, good people. I'm actually teaching you your act here. We are going through your act and understanding your act. You will have it in the exam. That's why we prefer the act over this other book there, because that one you don't take it into the exam. All right, so you look at the heading there, good people, and try to think about what is to follow. Sometimes when you read the heading, you will know what is going to follow because some of the things we did them in undergrad, but here we are doing them thoroughly. And with reference to the act, here you don't just calculate and go home and expect to pass. No. You need to know this information in detail. All right. So our section 10H talks about exemption of capital element of purchased annuity. It is going to address purchased annuities. Right. They say now, if you purchase an annuity, there is a portion that is going to be exempt when you receive that money in question. All right. So I will explain the issue of purchased annuity. Let's say you win lotto today, an amount of 500,000. Right. You can say, if I try to keep this money on my own, I can squander it. So what one can do is you can go to these insurance companies like Sanlam, Liberty, and other asset management companies and purchase an annuity. Purchase an annuity. How does this work? You would take your thing there, your Sanlam. You take your 500,000 and go and give it to Sanlam. And you say, Sanlam, I'm here to purchase an annuity. In return, Sanlam is going to be paying you maybe some monthly amounts, which are going to be an annuity. If it's an amount is annuity, say that is a fixed amount that is received over a fixed period of time. Then Sanlam in return, maybe they are going to pay you an annuity of 5,000 per month for a certain period of time. Now, as we can all see, that this 500,000 that was used to buy this annuity, it is more of a capital nature. It is a capital amount, the one that was invested there. And now what SARS is going to assume is that now, when you are going to be receiving these annuities, a portion of each and every annuity will be a repayment of the 500,000 that you invested. Are we together? It will be a repayment of the 500,000 that you invested. So what we need to do now is, if we are to calculate the taxable income for that person, we need to skin this 500,000 and remove the capital portion. The capital portion is not taxable as it is capital in nature. All right. So we have to do our section then. I'm simply going to go to section 10A3. That's where they are going to give us the what? That's where they are going to give us the whole story. They say the capital, the formula, that formula you might have to use it. They say the formula, the capital element is calculated by saying A is equal to A over B times C. All right, I'm going through here. I'm looking for a question. Who can be reading for us what Y stands for, what B stands for, what C stands for. I then explain those elements and then we move on. It mustn't take our time. It is something that is supposed to be straightforward. What is the Y, good people? People. You want us to learn like undergrad where I just come here and preach? All right, if you are shy, I will go through it myself. Y represents the sum to be determined. In this case, it is the capital portion. A represents the amount of the total cash consideration given by the purchaser. In this case, the purchaser paid 500,000 under the annuity contract in question as contemplated in paragraph B of the definition of annuity contract. So this is what you are going to give to the insurance company. And P represents the total expected returns of all the annuities provided for in the annuity contract in question. This represents the sum of all the 5,000 that are going to be paid to you. If they're going to be paid for 20 years, it's going to be 5,000 per month times 12 times 20. That's your P there. What about C? C represents the aforementioned annuity amount. Now, C is going to represent the annuity amount that you received in that year of assessment. Right, the word annuity is taken from annual amount. All right, now let's go to the question that I gave you. Now, the question that I gave you there, it is in the group, right? We need to read through that. You're going to be given this in the exam setup, purchase annuity. You need to identify it, that this annuity that the person is receiving, it's a purchased annuity. Therefore, it contains what? A fixed element. Let me take out the fixed element and then we do that. Let's move. Now I'm going to do that activity that I've just shared with you there. We need to go through it so that you'll be able to identify it in the exam. And you'll be able to do what needs to be done. Right, they say there that a man aged 38 years purchases a life annuity for 50,000. So the person bought an annuity for 50,000. So what is 50,000 there, good people?
A.
A is equal to 50,000. That's how much the person spent. The annuity is 3.6 per a year. It's 3,600 a year. What is that one?
It's C.
It's C, 3,600. Now the question is, what is our B? They go on to say, someone is saying struggling to connect. People, these documents are going to be there for life. They're going to be there for the whole of this year, isn't it? And should you repeat again, we'll be using the same logins. They're not changing. Right, but no one is going to repeat. Let's move. His life expectancy is 30.441 years, based on his age on his birthday, presiding the commencement of the annuity contract. The expected return is therefore, so the expected return is that this person will be paid 3.6 per year for life, is yet to live for 30.41 years. But in the question, you also have to pay attention. Sometimes this contract is not going to be a contract for life. You can buy an annuity that they pay you a certain amount, maybe for a certain number of years, if your money maybe is not adequate for you to receive the annuity for life. Right, we move on. So here is the thing, good people. If we are calculating the taxable income of this person, we are going to say annuity received. Annuity received. It is an amount of 3,600. Then we say section 10A. Section 10A there. We now have to go and remove the what? The capital portion, which we are going to calculate as follows. Now, the capital portion is 50,000 divided by that times this. We are removing now the capital portion of the 3.6 that was received there. It contains a capital portion. The capital portion, they've said it is 1,644. Right. That's what you'll be required to do in the exam to show that. That's the definition of exempt, good people. You don't say annuity, open bracket 3,600, then you remove the portion that is exempt like that. No, for something to be exempt, it must have gone through first into our gross income, and then we take it out. All right. What else did we say we would do today? What else did we say we do? So that is that. Oh, section 10. All right, now we move on, good people, to what we need to do today. Today I'm going to look at taxation of residence. We now find taxation of resident. Taxation of residence is done. We agreed that residents are going to be taxed on their worldwide income, isn't it? Okay. So today we are going to move on to non-residents. Taxation of non-residents. Right. We are looking at taxation of non-residents, good people, today. And how do we tax non-residents, if I may ask? Hey, we still far, good people. There's still a whole lot of things to be done. This test one, I think, is the longest of all the 4 tests. So let's do well in this test, then in subsequent tests, good people, it won't be this long. It's not going to be this long. Right, non-residents are taxed on income derived from a South African source. Derived from a South African source. Right. So for non-residents, we are only going to tax them on the income that they derived from South African source. That's how it is. On the income derived from the South African source. Right. Now let's look at source of income now. Source of income. When we talk about source of income, we have to consult section 9, and we need to consult our common law. Now, this is key, good people. Yeah, they don't play at CTA. You need to understand these things in detail. Some income is going to be said it is from a South African source in terms of common law. Some income is going to be said to be from a source within the Republic in terms of section 9. Now, people, how do we determine that the income is from a South African source in terms of section 9? Can we all go to section 9? We need to determine the source of income in terms of section 9. In terms of section 9. Where are the selected sections of our syllabus? Where are they? I'm trying to know which part of section 9 do we study. Is it all of it, or it's certain sections of sections 9, subsections of section 9? Right, let's go to section 9 there. It will tell us about the source of income. If an income accrues to a non-resident and you're not sure whether it is from a South African source or not, you are going to go to section 9 there. Section 9 is going to talk about what? Source of income. Right. I was trying to determine which one is not in the syllabus. And I'm seeing that what is in the syllabus is A, B. It's A and B. The rest, it is not in the syllabus. All right. Now, source of income. We read there. It says that now, for the purposes of this section, royalty means, okay, I'm not going to go through section 9, subsection 1. Now, talks about definition. I go straight to 2. They say an amount is received by or accrues to a person from a source within the Republic if that amount constitutes a dividend received by or accrued to that person. Constitute interest as defined in section 24J, where that interest syllabus is covering A only. So it's covering 1, so cancel 2. 2 is not in the part, is not part of the syllabus. Right, if that interest is attributable to an amount incurred by a person that is a resident, unless the interest is attributable to a permanent establishment which is situated outside the Republic. So as far as source of income is concerned, people, income can be from a South African source in terms of section 92A, being what? A dividend, or in terms of section 92B1, being interest that was paid by a resident. They say interest incurred by a resident. So if that interest that is paid to a non-resident is paid by a resident person, we say it is from a South African source. Right? So that is the source of income. Okay, now what about the common law? Now remember, good people, why are we learning this? You'll be required to discuss this. Someone received a dividend from South Africa. The person is a non-resident. Should the person be taxed on those dividends or not? We need to determine if those dividends are from a South African source. You will then have to say now, in terms of section 92A, the dividends originated from South Africa, therefore they are deemed to be from a South African source. The non-resident will be taxed on the dividends in question. You have given us that they are from South African source as defined there because they are dividends. If it's an interest that was incurred by a South African resident being paid to a non-resident, you would say that the interest amount of this much was paid by a resident person to a non-resident person. Therefore, it is deemed to be from a South African source in terms of section 92B1. Remember, they said that now if this interest was incurred to a job by the person who is paying it, incurred by a resident. Okay, now that is the story to do with what? Dividends and interest. Common law, we are going to look at what? Fixed property. If someone received rental income, and we are going to say that rental income is deemed to be from a South African source in terms of section 9, you get a 0. You get a 0. Remember, we don't do all those other sections in section 9 there. So don't even look at what is contained there. Right. If someone receives a rental income comes from one owning a fixed property. You are going to say the rental income is deemed to be from a South African source in terms of common law. So what common law says is that now the origin of rental income, it is from a what? From a place where the property is situated. That's common law. So you can write there. The origin of the rental income is from a source where the property is situated. Then you can say common law. So if I tell you that someone is receiving rental income, the person is a non-resident, discuss if the person will be taxed on that rental income or not. You have to tell me that the rental income is deemed to be from a South African source where the property is situated. Maybe it's Pretoria or whatever, you state where the property is situated. And then you need to tell us that this is in terms of the common law, not in terms of Section 9. Section 9 origin will only talk about dividends. All right, so that question can be discussed now. I can say, as far as the source rules are concerned, good people, I have taught you the source rules. How do you determine the source of income? You now know it. Now we need to move on to the next section that we need to talk about. Source rules, we are done. It's not like the whole of section thing is exempt, good people. These ones are not exempt, right? Section, there's another section here. Section 9(2)(I), the one for pensions, they say we do it. Section 9(2)(J), they say we do it. Section 9(2)(K), they say it is part of the syllabus. So we need to visit those ones as well. Right, you see from your study guide there, the sections that are in your syllabus, and those that are great, they are not part of your syllabus. If you turn to page 19. All right, so now there are other sources of incomes that we have to cover. Section 9(2)(I). Let's go to 9(2)(I). It's going to talk about what? It says, constitute a lump sum, a pension or annuity payable by a pension fund, pension preservation fund, provident fund, or provident preservation fund, and the services in respect of which that amount is so received or accrues were rendered within the Republic. So that is going to cover pension income. Right, pension income for services that were rendered within the Republic is going to be deemed to be from a South African source. That's your section 9(2)(I). If you see them triggering pension income, know that they are triggering that section. Section 9(2)(J), it is going to cover what? Constitute an amount received or accrued in respect of the disposal of an asset that constitutes immovable property held by that person, or any interest or right of whatever nature of that person or immovable property contemplated in paragraph 2. So now when it comes to immovable property, the capital gains are going to be deemed to be from South African source in terms of section 9(2)(J. But the rental income is deemed to be from a South African source if the property is situated in South Africa in terms of common law. I hope we are able to balance that, because the person who will be setting the paper, he'll be knowing these things, and he'll be knowing that they kind of can confuse the student. So let's not be part of those who are going to be confused. All right, and then 9(2)(K) talks about movable property also. It is part of the syllabus. Constitute an amount received or accrued in respect of the disposal of an asset other than an asset contemplated in paragraph J, if that person is a resident and the asset is not effectively connected with a permanent establishment of that person, which is situated outside the Republic, and the proceeds from the disposal of an asset are not subject to any taxes or income payable to any sphere of the government or any country other than the Republic. That person is not a resident, and that asset is attributable to a permanent establishment of that person, which is situated in the Republic. So those ones are going to cover your capital gains there. You will have to quote those specific sections. So sources, I'm done with people. Source of income. Remember why we have to do sources is because we said that non-residents are going to be taxed from income that is generated from a South African source. So if we are not going to be able to determine the source of income, it means that you cannot tell whether a non-resident should be taxed on that amount or not. Okay, so we're moving. We are moving now to Okay, I'm checking something. All right. Now, here is the thing, good people. Then the non-residents. How do we tax them? How do we tax them? How do we tax them? Let me see. Okay, so now we have to go. I'm looking for a certain page there that I need to see. Right. The next thing that we have to look at is going to be, when it comes to non-residents, good people, we have to say non-residents are subject to withholding tax on the income generated from a South African source. That's the main thing there. That's how we tax our All right. So the next thing that we have to look at now is withholding tax on what? On income generated from South African source. Remember, when you tax a non-resident, you are not going to say, bring all your income that you earned, even that which you earned outside the country, we want to tax it here. No, we are simply going to say, all right, there's an income that you generated from a South African source, pay a portion of it as tax, and that portion of it is deemed to be what? Withholding tax. That's the main source of tax that we are going to derive from non-residents. It's going to be withholding tax. But later on, we are going to talk about the issue of another type of interest, which is going to be taxed according to the normal rules, whereby you are going to tax a a non-resident of South Africa as if they were a resident. But can we park that one aside for now? Because it can dilute the key information that we have to master here. Right. So let's talk about this withholding tax. With the withholding tax, good people, what are we saying? Someone has to withhold. For instance, the withholding tax on interest, you don't have to write this because that's not the specifics of it, doing it. If the withholding tax in South Africa for interest paid to a non-resident is 15%, what it means is that if an amount of 10,000 accrues to a non-resident as interest from this person, what this person is required to do is he's supposed to withhold 15% of this amount that he has to pay over to a non-resident. This is the beneficiary of the interest. This is the person to whom the interest accrues. And this is the person who incurred the interest. Maybe this guy gave this one a loan at an interest rate of whatever percent, and that amount amounted to 10,000. Now this person, this resident, now has to pay interest to the non-resident. The tax that this interest is going to be subject to, we are not going to put it in the income tax framework for the non-resident. No, because non-residents will only tax them from the income that is derived from a South African source. And that type of tax, it is going to be withholding tax. So what do we mean by withholding tax? Given that the interest is at 15%, it means that now these guys, the person who is paying the interest, is the one who is supposed to withhold the tax on that interest. It is not SARS. You withhold the tax on that interest. The person who is paying should withhold the tax on that interest. Meaning to say that now 10% is what, 10,000 is what accrued to that person. And the withholding tax is 15%. This guy, he has to pay 85% to the non-resident. And the 15%, which is tax, must be paid to SARS. That's how we tax non-residents. Are we together? Are we seeing the art of it? Do we understand the withholding tax? The person who is paying the non-resident is the one who is supposed to withhold tax. Failure to do that, failure to withhold the 15% and pay 100% to that guy, this guy who paid the interest is the one who is going to be liable to the what? For the 15%. SARS will still want their 15%, even if you tell them that I made a mistake and pay 100% to that guy. They say, no, bring our 15%. So the effect of that is that now, at the end of the day, if this guy did not withhold the interest, he's going to pay 10,000 to the non-resident and 15,000 to SARS. Effectively, you'd have paid 115. So be careful. You have paid how much? It's going to be 11,500. So be careful when you're paying a non-resident. Consider if you are supposed to withhold any tax, or else that would be non-compliance with SARS, and SARS would want their portion. So it's more of they will be now penalizing you. Right. So when it comes to withholding tax, good people, this is how it works. Withholding taxes. There are only two for South Africa. You've got withholding tax on interest, as well as on what? Disposal of immovable property. Okay. For dividends, we don't have that withholding tax. We will talk about dividend tax, and that is going to be our tutorial later 107. Now, which sections talks about the withholding tax on interest? It is going to be section 50A to section 50F. Which sections talk about the withholding of interest on the disposal of immovable assets? It is going to be on section 35A. So let me explain the right-hand side there, section 35A. Right. On this side, we are saying that now, if a non-resident is going to dispose of an immovable property in South Africa, the person who is going to buy that immovable property, that's the person who is going to pay that non-resident. And that person who is paying that non-resident, he has to withhold a certain portion of the what? Of the price that he was charged. He's not going to pay 100% to the non-resident. He has to claw back, hold back a certain portion of the proceeds, and he will have to pay them over to SARS. So I think for us, it is easy if we start with section 35A. It is short and sweet, and we deal with it, then we talk about that. Can you go to that section, good people? I'm going to start by explaining to you the what withholding tax on the disposal of immovable property by a non-resident. Obviously, that property must be what? Situated in the Republic. Can we go to that section, good people? Okay. And again, we need to identify the sections which are in the syllabus. Right. In terms of this section, the sections which are in the syllabus is what? It is going to be 1 to 12. Because they are saying 8 to, no, 1 to 7, right? It's gonna be 1 to 7, and then 14 and 15. So which ones are excluded from our syllabus? It is going to be 8 to 13. So neatly cancel section 8 to 13. It is not part of our syllabus. All right. And here is the thing with people, as is always the case. I don't normally go through subsection 1 because I would say it is for a definition. But for the purposes of this section 35A, I'm going to go through section 1 there with you as well. All right. It says withholding of amounts from the payment of non-resident sellers of immovable property. Any person, I'm not going to read what is inside the bracket there. Any person who must pay any amount to any other person who is not a resident, or to any other person for on behalf of that seller in respect of the disposal by that seller of any immovable property in the Republic, must, subject to subsection 2, withhold from the amount which that person must so pay an amount equal to. All right, so you'll be charged a certain amount, good people, in a sales transaction. Okay, you're buying a moving property that is owned by a non-resident, and the selling price, out of that selling price, they need you to withhold something. Right, so here are the amounts. Right, equal to 7.5% of the amount so payable in the case where the seller is a natural person. In the case where the seller is a natural person. If the seller is a natural person, that Mr. or Mrs. that you are paying them, you must hold back 7.5%. Let's move on. 10% of the amount so payable in the case where the seller is a company. If you are paying a company, the property was owned by a company, you need to hold back 10%, meaning that you pay over 90%. In C, in the case of a trust, you hold how much? 15%. Right? A percentage of the amount so payable as the minister may announce. What did they? It just gives the minister the power to change those percentages, but it will not be the case in the exempt. Right? Then 1A also talks about the minister there. Right? You withhold on the amount so payable. Let's say there's a sales transactions of 10,000, 10 million. The house is being sold by Mr. X, who is a Botswana resident. This is the seller, and the buyer, we don't care, is just a South African resident. Now, here is the story, good people. It means that this guy, when he pays over, because the seller is a natural person, he will have to pay over what? 100 minus 7.5. He has to pay over 92.5% of the price of that 10 million to the guy there. And he has to hold back 7.5 million of the said price. This 7.5 is not for you, the seller, the buyer. You need to pay it over to SARS and say, here is the tax of the non-resident person who sold the property to me. Okay. If you change here and put a company, there we are going to put 90% paid over, 10% withheld. If we change there and put a trust, here would say 85% must be paid over, 15% must be withheld as withholding tax, and be paid over to SARS. All right, that's 2. That's 1. I'm done with my 1. I need to take you through your subsection 2. Remember now in the exam, you'll be required now to join these things with your English there. So yeah, know how you're going to put it down. Now we go to subsection 2. What are we going to hear there? The seller may apply to the commissioner in the form and at the place at the commissioner may determine for a directive that no amount or a reduced amount be withheld by the purchaser in terms of such section 1, solely having regard to. So they say now the seller may say, okay, I'm making this sales transaction, Mr. SARS. I know you will want your withholding tax, but may it please not be at either 7.5%, 10%, or 15%. May it please be at another rate, maybe 1%, or may it please be at 0% for now. Maybe I need that money, I'm broke, I need the whole of it. I will come back and pay my withholding tax for my pocket net. They say that is possible if you are going to apply to the commissioner, but you need to provide the following. You must provide any security furnished for the payment of any tax due on the disposal of removed property by the seller. It's like SARS will be granting you a credit. You should give them what? The security. Right? 2, the extent of the assets of the seller in the Republic. If you tell them that I can't run away with that withholding tax, I've got so many assets here in Zanzibar, SARS can grant you that right to get the 100% of the amount. Whether that seller is subject to a tax in respect of the disposal of the immovable property, they say that now whether also you need to consider if you are subject to tax or not, but you shall be subject to tax in most cases. Right? Whether the actual liability of that seller for tax in respect of the disposal of movable property is less than the amount contemplated in subsection 1. So if your tax liability is going to be less than those rates that are given there, they say you can also apply that no tax be withheld. Then they go to number 3, good people. When you're discussing these things in the exam, that's how you also move. Go to your section 35A. Yes?
Who applies? Who applies this?
Go to 2. Read for me the first 2 things there. On subsection 2. It says who?
Subsection 2.
The first 2.
Oh, okay.
Words.
No, okay,
it's fine.
I saw it. Yes.
Yes.
Thank
you. All right. 3A. The amount withheld from the payment to the seller in terms of subsection 1 is an advance in respect of that seller's liability for normal tax for the year of assessment during which the property is disposed of by that seller. I want you to highlight that part, people. Highlight that part, that this tax is an advance in respect of the seller's liability for normal tax for the year of assessment during which that property is disposed of by that seller. They normally test that. They say this tax which is withheld, good people, it is an advance tax. So the seller will still be assessed. And if that tax is going to be less than what the overall assessment is going to be, you'll be required to top up. If it's more, you'll be refunded. Now, you need to get this clear, good people, because now you will realize that now they said that this one, the withholding tax on the sale of removable property, it is an advance tax. It is a prepared tax. But this one, the 15%, it is going to be the final tax. Advanced tax, final tax. So you will hear about this. That's the difference between the 2 taxes. Sometimes you are required to distinguish between a withholding tax on interest and a withholding tax on the sale of a removable property. You need to state that now. The withholding tax on the sale of property, it is an advanced tax. The seller will still be assessed further, and it shall be determined whether the tax so withheld is more than or less than the final assessment. Yet, on the other hand, which you are going to see later, you are going to realize that now the withholding tax on interest is a final tax. You are not going to bother that seller, that person again. All right, let's move on to that 3 you have to highlight there, because in your discussion, that statement must be put down. Otherwise, your answer will be left hanging. All right, let's now go to B. If the seller does not submit a return in respect of that year of assessment within 12 months after the end of that year of assessment, the payment of the amount in terms of subsection 4 is sufficient basis for an assessment in terms of section 95 of the Tax Admin Act. All right, so I will read again. If the seller does not submit a return in respect of that year of assessment within 12 months after the end of that year of assessment, the payment of the amount in terms of subsection 4, we are going to hear about the amount down there, subsection 4, is sufficient basis for an assessment in terms of section 95 of the Tax Admin. So people, even though there's going to be the tax that is going to be withheld and paid over to SARS, this guy, they say he must submit a return to SARS for his assessment. He has to complete that form. I don't know whether it's IT or what, to say, SARS, I sold a remove a property. This is the gain that I made. This is the taxable capital gain that I made. And then SARS is going to assess the person based on the information furnished. And now, based on that returns was submitted, it can turn out that the final tax liability can be more than that 15%, which has already been paid in advance to SARS. If that's the case, SARS is going to say, all right, we have assessed you, your tax liability is so much, but because we received a withholding tax from the person that you sold to, we separated it, you still owe us a balance of this much. But if the assessment of that taxable capital gain is going to be a taxable capital gain, is less than or is more than this 15%, the difference between the assessed tax and the 15% or 10% or 7.5% already received in advance shall be repaid to the seller this time. Okay, you'll be required to connect that in your English, given a very long, big scenario there. Now let's go to subsection 4. The amount withheld by the purchaser in terms of subsection 1 must be paid to the commission. So in 3B, they made mention of the amount contemplated in subsection what? Subsection 4. That amount is the same as the one which is sitting on section 35A1. Those 7.5%, those 15%, those what? 10%. Remember, if we are to go back to B, they say that now, if we are not going to submit, if the seller does not submit a return in respect of that year of assessment, if you did not, if this guy is not going to furnish SARS with the income that was received from the disposal of that property, they say SARS will be content with the advance tax that was paid. They won't bother you. So it's two ways. You can shoot yourself in the foot if you submit your returns and then SARS tell you that the advance tax that has been received is not enough. But it can be to your advantage if you submit a return of the disposal of that capital asset, and it turns out that the tax that was withheld in advance there is more than your final assessment, because SARS will have to refund you. Okay, now we are on 4. The amount withheld by the purchaser in terms of subsection 1 must be paid to the commissioner where that purchaser is a resident within 14 days after the date on which that amount was so withheld. Now they are talking about this person. This person withheld a certain amount. Could be at 7.5%, could be at 10%, could be at 15%. They are saying now that this amount so withheld, if this person is a resident of South Africa, he must pay this amount in question to SARS within 14 days. Where that purchaser is not a resident, if this person, it was a non-resident selling to another non-resident, a property that is situated in the Republic, then this amount so withheld must be paid over to that particular person to SARS within 28 days. Those things, people, they must be visible in your answer. Right. If an amount has been withheld in terms of subsection 1 from any amount payable in foreign currency, so if the transaction was in foreign currency, that amount so withheld must be translated to the currency of the Republic at the spot rate on the date that the amount is paid to the commissioner. So if the amount withheld was in foreign currency, on the day that you are translating, on the day that you are paying that amount to SARS, we are going to use the spot rate to convert those foreign currency amount. So you can highlight there what you deem necessary. Number 6, the purchaser must, together with the payment contemplated in subsection 4, submit to the commissioner a return. So they say that now this purchaser, when you pay over this amount, you are going to submit a return. So meaning that you are going to do it by a way of a form. 7, a purchaser is personally liable under circumstances contemplated in section 157 of the tax admin for the amount that must be withheld under subsection 1, only if the purchaser knows or should reasonably have known that the seller is not a resident and must pay that amount to the commissioner not later than the date on which the payment should have been made if the amount had in fact been withheld. So here we are talking about that if you as a purchaser, good people, you do not withhold any amount that you paid over to the foreign person, and you knew or you ought to have known that you are paying this money to a non-resident, you shall be liable for the withholding tax that you failed to withhold. All right, so other sections 8 to 13 we don't do. So may we please proceed to number 14. So for each and every subsection, people, it's communicating something. For instance, if I say, what does section 35A7 tell us about? It tells us about the liability of the purchaser in instances whereby the purchaser failed to withhold a withholding tax. If I ask you, what is the significance of section 35(14), what are you going to say? All right, this section does not apply. So this withholding or tax thing and stuff like that, they say it does not apply if the amount paid by the purchaser to the seller and to any other person for or on behalf of the seller in respect of the acquisition by the purchaser of the immovable property in aggregate do not exceed 2 million. So if the property so sold, good people, does not exceed 2 million, you are not supposed to withhold those withholding tax, those earlier stated percentages altogether. So if they are going to bring a situation whereby a non-resident is selling to a resident, or a non-resident is selling a property that is situated in the Republic, but the selling price is below 2 million, let's not talk about this section 35A, because they do not apply to cheap property. That's what they are saying there. So you would state there, if they say discuss the tax consequences of the sale, I will state that now. This person is a non-resident. Non-resident are subject to tax from income generated from a South African source. This person sold immovable property to which is situated in the Republic. The person potentially should be liable for withholding tax on the selling price. However, in terms of section 35A(14), the withholding tax does not apply because the property in question was sold for less than 2 million. If the property was sold for more than 2 million there, you change color and say the non-resident will be subject to withholding tax in terms of section 35A because the selling price exceeds 2 million. 2 million. Then you state there that since the seller is a natural person, the withholding tax must be calculated at 7.5%, or if it's a company at 10%, if it's a trust at 15%. Then you will also have to make mention what we said you should highlight in 3 there, that this withholding tax is not a final tax, it is simply an advance tax. The seller will still have to be assessed. All right, or if you want, you can discuss all the way from 1 so that you don't skip anything all the way. All right, so this section does not apply in 1. We've been told circumstances under which it does not apply. That is 14A. Let's go and find out under what circumstances does this section not apply in terms of section 14B. In respect of any deposit paid by the purchaser for purposes of securing the disposal of the immovable property by the seller, to that purchaser until the agreement for that deposit has become unconditional, in which case any amount which would have been required to be withheld from the amount of that deposit must be withheld from the first following payment made by the purchaser in respect of that disposal. Okay, like for instance, normally in an auction, we are required to pay something to go and participate in that particular auction. So that upfront payment, that deposit to secure the purchase, they say that no withholding tax must be done. All right, fine. 15, you're going to do it on your own. It's just a definition of terms. Right, so the first withholding tax, good people, it is done. You can do a question on that one. Hey, let me look for a question, but I remember I once saw it in this one of the. All right, take a break. I'll see you at 10 past. I'm looking for a question on this one. We will have to do it before we dilute it with the interest one. All right, break. See you at 10 past 4, 10 past 2.
Matano ki man karonya ko tuna le mo rumunyak.
All right, people, we are back. There's a question that I want us to do. Is to deal with the withholding tax. It's taken from a past paper there. So that's the type of questions that they will ask you. Right, I will share the question here and also shared it on the group there. Right, our question is going to be part D. Right, for our studies, we go first to the scenario, then we go to the required. Now, Jack Rees is the guy that we are going to be looking at there. Jack Rees is an Australian resident. So we are talking about a non-resident here before us, good people, who served on Med Experts Board as a non-executive member for more than 10 years. But in the beginning of September 2019, Jack decided to retire. He was the sole owner of a holiday home in what bay? Hey, so that name now is tricky because if you don't know that it is a place in South Africa, right? What bay? Let's assume it's a place in South Africa. I believe it is. Okay, in what bay there? Jack bought this house on 10 August 2010 for 2.8 million. Over the years, he effected improvements at a cost of 400,000 to the property. On 10 January 2020, Jack sold his house, his holiday home to Rick, a South African resident, for 4.350,000, including the estate agent's commission of 320,380. The holiday home was registered in the name of the new owner on 20 February 2020. So what are we seeing there? We are seeing a non-resident person selling a property that is situated in the Republic to a resident person. Non-resident person, being Jack, is a natural person. We go to D. D now says, explain to Jack Rees all the tax-related matters pertaining to the holiday home that he sold during the 2020 year of assessment. Then they say, calculate his South African taxable income for the 2020 year of assessment. Right? Assume that he has no other income or capital gains from South African source, and he has not incurred any other expenditure for the 2020 year of assessment. All right. So that question is in two parts, all the tax matters. All right. So we are going to discuss here. Now, what we saw here, we have to discuss. So now a better way of discussing something like this, good people, is to flow with your section. You see that they didn't make mention of section 35A. So the examiner will trigger a certain section in your Income Tax Act in their question. So now it is for you now to identify the section being triggered, and then you go on to do the things for that section. And then you go and do the things for that particular section. Okay. All right. We move on. Now, here's the thing. We are going to say, we have seen that section 35A applies. The cost price was more than 2 million. We are going to do this. We are going to say, I want now to apply section 35A. I'm just showing you the flow of your discussion. In that section, I would say Jack is a what? Because I need to address the heading that it is applicable only if a non-resident sells a movable property situated in the Republic. Now, in my application there, I can start with this one, which is the heading. I can simply say Jack is a non-resident person, right? And Jack sold a property that is situated in the Republic to Rick, a South African resident. Now I come to apply this one now. Section 35.1, what 35A1 says. I would say that now, Jack is a natural person. Therefore, Rick will have to withhold 7.5% of the selling price as the withholding tax on the sale of the property. Then I would say now, the withholding tax on the sale of their property amounts to 7.5%. The selling price, we said, is this, right? You will calculate your withholding tax there. It's 326250. Right, I have addressed my one there. Okay, I picked what I want. Then I can go and try to talk about this one. 2. What do you say in 2? In 2, they say that now you can waive, or you can decide to waive that amount of 326 being withheld and stuff like that, provided you make those what? Provided you make those things that apply in section 2, section 35.2. In this case, I would say that section 35.2 does not apply, as Jack did not apply to the commissioner, right, for a directive that no amount or a reduced amount be withheld by the purchaser. I move, addressing section by section. 3 now. On 3 there, what am I going to say? On 3 there, what am I going to say? You have highlighted this thing. I'm going to say the withholding tax of 326250 is not the final tax, or the withholding tax of 32650. It is an advance tax in respect of the seller's liability for normal tax for the year of assessment during which that property is sold, or for the year of assessment. This happened in which year of assessment? You state the year of assessment there. That applies. Right, from there I move on to go and apply section 35A4. That one talks about, I would say, the amount withheld by the purchaser in terms of subsection 1 must be paid to the commissioner. They say where the purchaser is a resident. I would say that the amount withheld, which amounts to 326,250, should be paid over to the commissioner within 14 days because the purchaser, Rick, is a South African resident. Section 35A, what I'm going to say there, I would say section 35A, section 35A5 does not apply as the selling price is denominated in South African rands. I move on to another section, 6. I talk about the things that I found there in 6. The purchaser must, together with the payment contemplated in subsection 4, submit to the commissioner a return. Then I'll say Rick will have to submit a return together with the amount of 32650, so withheld. I move on to another one, 7. A purchaser is liable under that. I can say that, okay, I can say that now should the purchaser, should Rick fail to withhold the amount of tax or withholding tax, Rick would be liable for the withholding tax. I've stated that. Then I go to section 35A14. Okay. This section does not apply. I would say that now, I can repeat that Jake is liable for what? For withholding tax as the property was sold for more than 2 million. If maybe having discussed all these things, I discover only that the selling price was 1 million. I will have now to come and what? And cancel everything. To say, okay, the withholding tax discussed above is not going to be applicable in this case because the selling price was less than 1 million. So, but I suggest that before you go further, first go and before you discuss section by subsection by subsection. First check whether your section 14 applies. If the selling price is below 2 million, you can quickly say without wasting time that section 35A does not apply because you state why it does not apply. All right, I'm not going to go to definition. Right, back to our question to understand if we answered everything. Explain to check all the tax matters relating to the what? To the holiday home that he sold. Then they say, calculate his South African taxable income. Remember what we said, that withholding tax is not the final tax. It is an advanced tax. SARS will still have to assess him based on his capital gain that he made. So now I have to calculate now the what? The taxable capital gain. Because upon assessment, this guy will have to submit his return to do with the capital gain that he made. Right, that one is going to be your proceeds less base cost. We are going to do our capital gain in full. You get there, then you say less annual exclusion of how much? Annual exclusion of 40,000. Okay, you get your amount there. Right, the question said, right, assume that he has not capital gain, calculate taxable income. Okay, they want us to calculate only the taxable income. So the taxable income is what is going to be included in his taxable income. Thereafter, I can say taxable capital gain at 40%. Remember, the annual inclusion for natural persons. Right, we want figures here. This property was sold for 4,350,000. Our base cost, we're told that it was bought for 2,800. Plus, there were improvements that amounted to 400,000. Plus, there is estate duty commission that amounted to 320,380. This becomes our base cost. But we are going to learn in detail the stories about what capital gains. It is going to be our next topic there, which we are going to look at possibly today. 3520, 380, that, and then we separate our proceeds, we get 829, 620. We separate the annual exclusion of 40,000. It will take us to 78, 789, 620. Then we get 40% of that, the annual inclusion. This becomes the taxable income. Okay, it is an exam that was written by other students. So you will write also a similar thing. Then you state there that this taxable income shall be assessed in the hands of Jack. All right, people, I've covered that one. We are moving on. Okay, anyone with questions? We can discuss, we can calculate. Any question there? No questions? Okay, so if there are no questions, good people, I no longer owe you this one. You now know it's an advanced tax. You now know that is applicable when a non-resident sells move a property. You now know that if that cost of the moving property is more than 2 million. So sharp, done. Now let's jump to this side. We don't have withholding tax on dividends, right? We don't have. We don't have withholding tax on dividends. So we'll talk about withholding tax on interest. All right. Withholding tax on interest. Now, when we talk about withholding tax, people, we should be having a non-resident. When we talk about withholding tax. So when I say withholding tax on interest, I'm saying on interest paid to non-residents. Okay. Right. Then we start. Okay, I need to get a section there before I can give you notes. Right, I am going to say now, if interest paid to a non-resident is not exempt in terms of section 10(1)(h), or is exempt, sorry. If it is exempt in terms of that section, is exempt in terms of section 10(1)(h), then it will be subject to withholding tax. Withholding tax at 15%, unless the said interest is exempt in terms of section 50D. Okay, you have to explain that. Right, so we are saying that now the interest accruing to a non-resident, if it is going to be exempt in terms of section 10(1)(h), we are going to go to that section. If it is going to be exempt in terms of section 10(1)(h), then that interest shall be subject to withholding tax at 15%, unless that said interest happens to be exempt in terms of section what? 50D. Now, section 50D, it exempts certain interest from withholding tax. Are we together? We are talking about non-resident here. Right. Now let's go to section 10(1)(h) and find out which interest is exempt in terms of that section. Remember what we said, we are going to pass it on. If interest, right, if it is exempt in terms of section 10(1)(h), then withhold interest, then withhold tax at 15%. Right, this 15%, it is going to be 15%. This is our section what? 50P. Right, unless it is exempt, it's exempt in terms of section 50D. Now 50D, it is an exemption on withholding tax. Section 50D is an exemption on withholding tax. So we can find out that a certain interest for people, it is going to be exempt in terms of section 10(1)(h). You try to tax it at 15% in terms of section 50B. You can't, because that interest also turns out that it is exempt in terms of section 50D. So meaning that that non-resident is going to receive that interest in full. No portion of it is going to be taxed. Right, now this is what you are going to do, good people. In your flagging there, we are going to start on section 10(1)(h). to find out which interest is exempt in terms of section 10(1)(h). So there you need to flag liability. You need to go and flag in this 10(1)(h there, what you're going to flag there, you put that thing for flagging. You also make reference to section 50B. You also make reference to section 50D. Because what we are saying is, if you have got foreign interest, we are going to start there. If they say a non-resident person received interest from a South African source, we are going to start there and say now, if they say discuss the tax consequences, we say, is this interest going to be exempt in terms of section 10(1)(h)? If it's going to be exempt in terms of that section, we are going to exempt it. If we exempt it in terms of that section, we need to proceed to section 50B and tax it at 15%. But before doing that, we must consider if we can exempt it in terms of section 50D. Yeah, so that's how they put it. So in your flagging there, actually you can start by considering section 50D before you consider section 50B. So that now in my discussion, I'll say now that they would say maybe discuss if the interest that is accruing to the non-resident or discuss the tax consequences on the interest accruing to the non-resident. I'll consult this. I'll say that the interest in question is from a South African source in terms of section 9(2)(b)(1). And then I'll say that now the non-resident will be liable on tax on this interest. Then I'll go to this section. When I go there, if they tell me that that interest is exempt, I'll say that the interest in question is exempt in terms of section 10(1)(h). Therefore, one has to consider if the interest in question shall be subjected to withholding tax at 15%. Then I go to this section. If that interest also is going to be exempt in terms of section 50D, the non-resident person is not going to be taxed on that interest, and no withholding tax is going to be applicable. I will state that again on the next line, that this interest is also exempt in terms of section 50D, so no withholding tax shall be withheld on the interest in question. Therefore, no tax consequences for this interest. But if that interest is exempt in terms of section 10(1)(h), and it is not exempt or not exempt from withholding tax in terms of section 50D, I would say that a withholding tax at 15% must be calculated in terms of section 50B. Do you understand how these sections they pass on interest to each other? So flag them nicely there, because we don't have a situation where when you get foreign interest, you are only going to get stuck on section 10(1)(h). There are other sections to be considered. Now, if the interest is not exempt in terms of section 10(1)(h), you will include it in the gross income of the non-resident. Right? If it is not exempt in terms of, so we are going to say interest to non-resident. You consider this. If they say exempt, you go on to section 50D. And then if not exempt in terms of section 50D, not exempt in terms of section 50D, go and calculate withholding tax at 15% in terms of your section 50B. Now, this process that is followed there, good people, in most cases, you'll be describing it in what? In English. That this interest accruing to a non-resident, it is exempt in terms of section 10(1)(h). Therefore, one has to consider if the same interest shall be exempt in terms of section 50D. Then if it turns out that that interest is not exempt in terms of section 50D, you then have to say the interest in question will be subject to withholding tax at 50% in terms of section 50B. We are going to go through these sections together, good people. Don't worry. Right. If it is going to be exempt in terms of what? Not exempt in terms of this section. If it's not going to be exempt, not exempt in terms of this section, we are going to what? To exempt in terms of what? Section 10(1)(I). That interest, in other words, we are going to say, if I'm to fit in something good there, good people, we are going to say include in gross income. Include in gross income of that natural person. Include in gross income of that natural person. Here we are talking about interest to non-resident, and that non-resident being a natural person. It is the route that is going to be considered. My natural person, I should put it this side. Before we go to our act, I can put it this side. Natural person. Are we able to describe that process in English, good people? Because when they ask you about the interest that is accruing to the non-resident, the examiner is going to choose whether he wants you to describe that route or that route. In English. All right. Now let's start on section 10(1)(H). Can we go there? 10(1)(H) talk about the interest accruing to a non-resident. Okay, let's go there. Let's go there. Okay, we are there now. Now remember, section 10, they would have said the what exemptions. Then we go to H. It says any amount of interest which is received by or accrues to any person that is not a resident. So can I like not a resident? Unless, so any interest that accrues to a person who is not a non-resident, good people, it is going to be exempt unless that person is a natural person. Right? Unless that person is a natural person who was physically present. That's why I said if the person in question was a natural person, you have to come decide. Who was physically present in the Republic for a period exceeding 183 days, highlight 183 days in aggregate, during the 12-month period, presiding the date on which the interest is received by or accrues to that person. Or the date from which the interest arises is effectively connected to a permanent establishment of that person in the Republic. So we're saying any interest that accrues to a foreign person, people, it is going to be exempt. We follow that route. But they say, however, if that interest accrues to a natural person, and that natural person has been in the Republic for a period of more than 183 days, such interest is not going to be exempt in terms of that section. So we are going to tax it in the hands of that natural person. Or the interest in question, it arises from a permanent establishment that is actually what connected to this person. For instance, a person, he has got another branch that they own in the Republic, or another division of their companies, and that division is the one that is paying interest to them. We are going to tax it in their hands. So that will be the story. If the interest is not exempt, if the interest is not exempt in terms of section 10(1)(H), we are going to include in that person's gross income, and we are going to exempt a portion of that interest in terms of section 10(1)(I). That one talks about, we look at the edge of the what? Of the taxpayer. Right. However, if the interest is going to be exempt in terms of section 10(1)(H), that's not the end of everything. That interest may be subject to withholding tax, provided that very same interest is not going to be exempt in terms of section 50D. 50D is an exemption on withholding tax. All right. So, yeah, we are done there. Can we go now to these sections? Now, if you check there, they said we need to start the section 50A to section 50F. Can we go and start with these sections? Right, during break, then I'm going to look for a question on that one. All right. So 50A, I'm not going to go through 50A with you good people. It is definitions. I'm going to take you through section 50B. Let's go through section 50B. Right. It's a withholding tax now. Now we are talking about withholding tax. It says that levy with withholding tax on interest. They must be levied for the benefit of the National Revenue Fund, a tax to be known as the withholding tax on interest, calculated at the rate of 15%. You can highlight that one, 15%. So I'm not going to read the second one. The 2-1, it is the one that gives the commissioner the powers to change that 15% to any percentage. I will leave that one. 15% of the amount of any interest that is paid by any person to or for the benefit of any foreign person, to the extent that the amount is regarded as having been received or accrued from a source within the Republic in terms of section 92B. So I want you to highlight paid there, because this withholding tax, it is only based on the amount that has been paid, on the amount that you want to pay, you hold back something. All right, I'm not going to go through B there. It is less important because it says that now if the commissioner changes the rate, if the commissioner says something, good people, we follow. The commissioner can change the whole act and say, now I want tax to be calculated 200%. The commissioner's word will be final. We won't argue with the commissioner and say, but the rate according to the act is 10% now. All right, we move on to subsection 2. Subsection 2. Now, the way these acts are presented, good people, remember when you are discussing, you'll be moving from 1, we have said that the rate is calculated at 15%. Subsection 2, we are going to say now, for the purpose of this part, interest is deemed to be paid on the area of the date on which the interest is paid or becomes due and payable. See now, they are now twisting what they gave us there. So they say now, if the interest is due and payable, it is deemed to have been paid. If the interest has been paid, it is deemed to have been paid. So if they gave you the date the interest was paid, or the date the interest became due and payable, you are going to say the interest is deemed to have been paid on this day, being the earlier of the two. Right, section 50A3. What do we have there? What are you going to put down? The withholding tax on the interest is a final tax. You see this one, you need to highlight it, could be. Unlike the one for sale of immovable property, whereby we said that this is an advanced tax, this one is a final tax. If you go to your section 35A3, there they said that one is an advanced tax. When you come to 50A3, they say this one is a final tax. Surely the marker will be looking at what, giving you a whole lot of marks there to demonstrate that this person will not have to submit any return. The 15% that we take from their interest is final. All right, now what do we have sitting here? It is in the syllabus, right? That one? If it's not, you have to tell me. It is. They say in number 4 now, where a person is making a payment of any interest, any amount of interest to or for the benefit of a foreign person has withheld an amount as contemplated in section 50E. We will see what do we have in 50E there. That person, for the purpose of this part, be deemed to have paid the amount so withheld to that foreign person. So they are saying the obvious thing. That now, if the interest in question is what? 10,000. You pay over 8.5, but you'll be taken as if you paid the foreign person 10,000. So this foreign person cannot come and say, you only paid me 8.5. I still need my 1.5, referring to the one that you paid over to SARS. They say you are protected by the law. You are deemed that you paid the full amount to the foreign person. That's what section 50A4 is saying. That's what you're also going to say there in your answer, that, okay, the Mr. X is deemed to have paid the full amount of 10,000 to the foreign, to the non-resident person. This is the actual amount we are saying. Okay, yes?
Sorry. Mr. Tulusan,
Yes.
sorry to interrupt. Are those subsection within 5A or is it 5B now? Are we 50B, not 5B? Are we
Yes.
not
Oh,
50B?
50B
okay, so
actually.
this is the
Yes.
OA is for definition. I say you do definitions on your own, right?
Yes.
I'm not taking you through OA. Sorry, yeah, thanks for that observation. 50A, I'm not going to take you through for 50A, it's just definitions that you can read and understand. Yes. So now that one talks about the levying of withholding tax. So in the discussion, you will state there. Right, we move on to section 50B5. What are you going to say there? We don't have this one. So as far as the discussion in section 50B is concerned, you are only required to say that. Right, let's go to now section 50C. They say it is in our syllabus also. Right, a foreign person to which an amount of interest is paid is liable for the withholding tax on interest to the extent that the interest is regarded as having been received or accrued to that person from a source within the Republic. So 50C1, they are saying that now, the person who is deemed to have paid this 1.5, it is the foreign person. This guy, yes, is going to take it over to SARS, but when SARS receive this money, they will deem that the money is coming from the foreign person. They know that when you are just a representative of that foreign person. So you'll say that now the amount of 1.5 is deemed to be withholding tax received from the foreign person. Okay, you'll be discussing there. What are you going to discuss in 2? Where any amount of withholding tax on interest is withheld as contemplated in section 50E, we are yet to get there, and paid as contemplated in section of 50F2. That amount of withholding tax on interest must be regarded as an amount that is paid in respect of that foreign person's liability. So you state there that this amount of withholding tax is regarded as the foreign tax, the foreign person's liability of tax. So it's more of a repetition of what we saw there above. Right, so we are done there. And then we go to section 50D. Right, 50D is going to talk about exemptions. Right, so now the way the Act is written, good people, it is written in such a way that they make life difficult for us. Because under normal circumstances, they should have discussed the exemption first, so that now if that interest is exempt, we don't have to proceed and talk about a whole lot of things. We say that now, no withholding tax on interest, the interest is exempt, and end there. But the way the Act is written, they will tell you how this withholding tax is calculated, who is deemed to be liable. After that, they go and tell you in terms of section 50D, some interest paid to foreign persons are going to be exempt from withholding tax. That's why here I said now, in your discussion, you have to visit D first and determine if it's exempt or not. If it's exempt, you are not going to go further. If it's exempt from withholding tax, you tell them that no withholding tax is payable on this interest because it is exempt in terms of section 50D. If it's not exempt in terms of section 50D, you proceed and discuss how the tax is going to be calculated as detailed in section 50B. Okay, that's the CTA, good people, welcome to it. We are fewer. Right, 50D, exemption from withholding tax on interest. They say subject to subsection 2, they must be exempt from the withholding tax on interest, any amount of interest. I want you to cancel CC because CC is not in the syllabus. CC is not in the syllabus. So now we are hearing which interests are exempt from what? Withholding tax. We'll pay attention. If that amount of interest is paid to any foreign person by A, the government of the republic, in the national, provincial, or local spheres. So these taxes, these interests that we pay over to China, these interest on loans that the government pays over to China, they are not subject to any withholding tax because they are paid by the government. Right? All right, we move on. So any interest, if the interest so paid to a non-resident people, it is paid by the government of the republic, it is not going to be subject to any withholding tax. B, any bank. So if the interest paid to a non-resident is paid by FNB, is paid by ABSA, is paid by NetBank, etc., Capitec included, it is not going to be subject to any withholding tax. The person is going to receive their interest in full. Nothing must be held back. Right. And then we had U1, AA in the syllabus, BP in the syllabus, CC not in the syllabus. Let's go to 2. Now, which other interest is exempt from withholding tax, people? I want to see if we are following. And that interest is sitting on 2. Which other interest is exempt from withholding tax? Are we there in that section, good people? Good people. Which other interest is exempt from withholding tax? Go and look at your 2 there, I told you. All right, I'll say maybe because we are muted, but are we all seeing that now? If the interest in question is in respect of what? Of any listed debt. Listed debt. If it is to do with in respect of a listed debt, normally they will tell you in the question there. All right. Okay, then you can maybe read the other. And then another section that I want us to go to, it is going to be your section 50D3. That one you already know it. It's equivalent. Okay, let's go to it. A foreign person is exempt from withholding tax on interest if that foreign person is a natural person who was physically present in the Republic for a period exceeding 183 days in aggregate during the 12-month period preceding the date on which the interest is paid. Remember this one, it was also echoed in section 10(1)(h). That now, if you have been in the Republic for more than 183 days, we are not going to exempt your interest in terms of section 10(1)(h). We will tax you in your hands. The fact that it's going to be taxed in the hands of the recipient, right, in terms of section 10(1)(h), the fact that we are not going to exempt it, it means that you cannot pay tax in your income tax, in your tax of income, as well as withholding tax. Or the debt or claim in respect of which the interest is paid is effectively connected with the permanent establishment of that foreign person in the Republic, which is okay. If you read your section 10(1)(h) there, well, you will realize that now, if you have been in the Republic for more than 183 days, and you are a non-resident, you are a natural person, the interest that is paid to you, it is not going to be exempt in terms of this section. It is going to be taxed in your hands. Once it is not exempt in terms of this section, not exempt in terms of this section, it is going to be taxed in your hands. They are talking about this route, not exempt in terms of section 10(1)(h), including gross income, exempt the portion of 10(1)(i). Then if it's exempt, you take that route. Okay, I hope that one is valid. is quite clear. Right, section 50E, what do we have there? Withholding tax on interest by payers of interest. There they are telling you something that you already know could be. Okay, I may choose not to go through that one. Do you have a debt there? We are saying in that one that the person who is paying the interest is the one who is supposed to hold back the interest. Is the one who is supposed to hold back the interest. So I've told you that the payer is going to pay the net amount. Go through that one on your own, good people. And then finally, section 50F. 50F talk about the payment and recovery of tax. Now you have withhold that interest. Now you need to pay it over to SARS. You pay there. It is not your money. So, all right, then we dive into our section 50F. It says that now, if in terms of section 50C, a foreign person is liable for any amount of withholding tax on interest in respect of any amount of interest that is paid or for the benefit of the foreign person, that foreign person must pay the amount of withholding tax and submit a return by the last day of the month following the month during which the interest is paid, unless the tax has been paid by any other person. So this one, you are going to submit a return before the end of the month, following the month in which the interest was paid. That's it. Then U2 then, that was one. It says that the foreign person must submit a return. You submit a return, even though you know that this is your final tax. They are not going to say, we still need more from you. No, it is just a formality. Now, what does section 50F communicate to us? Any person that withholds any withholding tax on interest in terms of section 58 must submit a return and pay the tax to the commissioner by the last day of the month, following the month during which the interest is paid. So in your discussion there, maybe the interest was withheld in August, you need to say that now the person who withhold the interest, he has to submit a return and pay over the interest to SARS before the end of September or before 30 September, because we all know that September ends what? It's got 30 days. All those are marks which you are going to be adding, good people. What are you going to say there? Any person that pays withholding tax on interest in terms of section 50E in respect of interest due and payable but not actually paid must submit a return by the last day of the month following the month during which the interest became due and payable. Okay, so here they say if the interest has been paid. Here we are talking about if the interest has accrued. You now have got the interest liability, but you haven't paid it off. You still have to submit that return. Just that. All right, so as far as our withholding taxes are concerned, good people, we are done. We don't have the dividend withholding tax. We don't have dividend withholding tax, but we have got dividend tax, which they say we are going to discuss it later in our last test 4, if you check there. Right. Any questions on this one? Any questions on this one? Let's see if we can talk about something. Question 2, there's a question 2. All right, I'm trying to see some little bit of application of these. A little bit of application of this, then maybe we move on to the next thing. No, this test is long. So people be in a position to discuss these things. When you discuss these things, remember, you have to simply go according to the sections there, attacking everything bit by bit. That's not number 6. Say the interest and by dev, left investment with the local financial service. That. Now, who is this dev? Okay, I'm trying to see if I can get a question on this one. On this one. All right, see you again at 3:10.
Hello, I want break.
Yes, we are.
All right.
Okay, okay, thank you.
Yes, break until 10 past. Okay. Yeah, our break is up. Let's move. Let's move. All right, good people. So this is it. I've just shared a question there that I want us to go through as far as the discussion of these taxes are concerned, withholding tax on interest. So I'm simply going to go to the note that we want to look at. This is a paper that was written by other students as their final exam. And these are the type of the questions that we should expect. So I'm only going to focus on note number 6. It is the one that deals with what? It is the one that deals with the interest that we want. Right. So here we are going to look at our discussion of section 10(1)(h) as well as our section 50A and section 50 up to 50F. You will see how these questions are going to be set. At the end of the day, people, our enemy is the exam. So we should learn how are we going to answer this in the exam. Right. So we need a brief background there. Dev is a 30-year-old, we need the age, old, and was born in the UK. Dev has worked for the British Medical Supplies Company as a senior sales representative for the past 18 years. In October 2019, Dev was approached by Bassett South Africa Limited and offered a 2-year sales representative job based in the Cape Town. Bassett SA Limited is a South African resident company and a vet vendor. Dev accepted the job offer with Bassett SA Limited and moved to South Africa on 1 December 2019. He came into South Africa on this day. Dev had never been to South Africa before accepting the job offer, and he did not immigrate to SA either. So it is the first time that Dev is in South Africa. Dev was physically present in the Republic for 91 days in the 2020 year of assessment. So I don't think that was actually necessary for them to tell us that. Just a repetition. If they told us that this person entered the Republic on that day, and they want us to calculate the interest. So the question here, I did not put it here, but it was to discuss all the tax consequences that Dev, discuss all the tax consequences for Dev. They wanted us to discuss all the tax consequences for Dev. Okay, so you can have that as a question. Right, for the 2020 year of assessment, discuss all the tax consequences for Dev for the 2020 year of assessment. All right, now Dev income and expenses for the 2020 year of assessment are as follows. I'm going to focus on this one. Amounts received. They say local interest received, not 6. He received 32,500. Okay, we go to note number 6. The local interest earned by Dev. Dev is a non-resident, right? Even if you apply your physical present test, you will realize that Dev is a non-resident. It relates to the investment with a local South African financial services institution. It is not an investment with a bank. The interest is not coming from the bank. The interest is not coming from the government of the Republic. So that interest is not exempt from the dividend, it's from the interest withholding tax in terms of section 50D. The interest was paid to Dev on 29 February 2020. Don't forget what I said the required is. Discuss all the tax consequences to Dev of the interest received from South Africa. Discuss all the tax consequences for Dev for interest received from South Africa. Right, now this is how you're going to do it. It can be even out of 10 marks. Right, tax consequences of the interest, tax consequences of the interest received by Dev. Now I'm going to say that the interest,
I don't know if it's only me who doesn't see a screen.
you don't see my screen.
Uh-huh.
Now you can see it, isn't it?
Yes.
So everyone, you were not seeing my screen, could be.
I can see your screen, Tulisani.
Okay, all right. So, all right, now, so in discussing that with people, where do we start? We need to say Dev is a non-resident. To tell the marker that we are taxing a non-resident. Or another student can say Dev is a UK resident. Or those two statements mean the same thing. Then now I'm going to say a Dev received interest of 32,500, 32,500 from a financial institution. Financial institution. It is key that I state where the interest came from, because if it was from the government, if it was from a bank, I might say that it should be exempt. Right, the other thing that I need to state there, I would have to say now, the interest received. The interest received by Dev is deemed to be from a South African source, from a South African source, in terms of section what? In terms of section 92B1. Now you are actually, remember what we have at the back of our mind is that now non-residents are taxed from income that came from a South African source. So if you are going to start taxing that interest without stating that it is from a South African source, it is going to be a problem. We need to state that it is from a South African source before you can go ahead and tell us how it is going to be taxed. Also, you need to indicate to the market that I'm seeing that this person is a non-resident. I am seeing that he received an interest. I'm seeing that the interest is deemed to be from a South African source in terms of that section. We have to go forward. Now, I can say it's a discussion question. I can say one has to consider if the interest is exempt in terms of section 10(1)(h). Before you can talk about the withholding tax, go via that section. Could be any interest from accruing to a non-resident. We go through that section. Then I can say that it has to be considered if the interest is exempt in terms of section 10(1)(h). Right. It is going to be exempt in terms of section 10(1)(h) if someone has been in the Republic for a period of at least 183 days, if the person is a natural person. I can state there that Dev is a natural person also. Dev is a natural person because it also has got an impact on the road to that I follow. Right, so now I need to test. They say he came in the Republic on this day, and our year end is 29 Feb 2020. How many days do we have there? December has got 31 days, January has got 30 days, February they say it's 29 days. Oh, January 31. So Dev has been in the Republic for how many days? For 91 days, isn't it? Are we together? Now let's go to section 10(1)(h) there so that we'll be able to discuss this. So if the interest is exempt in terms of that section, the whole of it, remember, it's not partial exemption. Right, now I have to go there and test if this interest is going to be exempt in terms of section 10(1)(h). What is your conclusion, good people? Dev has been in the Republic for 91 days. Is this interest going to be exempt in terms of section 10(1)(h)? Any amount of interest which is received by or accrues to any person that is not a resident is going to be exempt unless that person is a natural person who was physically present in the Republic for a period exceeding 183. So now I would say Dev has been in the Republic for 91 days. Therefore, the interest is exempt in terms of section 10(1)(h). Once it's exempt in terms of this section, good people, what do? We proceed now to consider the withholding tax consequences. Now, in my next statement, I say, as the interest is exempt, Yes?
Please, can I take a screenshot?
Oh, this one. Okay, yes. Now we are
Okay,
saying
thank
it is
you.
exempt in terms of section 10(1)(h). Remember, once it is exempt in terms of that section, we are taking this route. The examiner tested this side. Once it's exempt in terms of this section, we need to consider that. So that's where I'm going now. And that should be your flow of discussion. As the interest is exempt in terms of section 10(1)(h), one has to consider the withholding tax effect on the interest. Right. So now, before I dive to how it is calculated and stuff like that, I need to consider my section 50D. Is it going to be exempt in terms of section 50D? Let's go there. Because I don't want to discuss that it is going to be calculated at this rate, only for it to turn out indeed that it is going to be exempt. 50D, the interest is going to be exempt from withholding tax if it's coming from the government, the South African bank, or is in respect of a listed debt. So now I have to state there that now the interest is not exempt from withholding tax. Right. Now, if it's not exempt now, I now need to say, how is it going to be taxed? Because it is not exempt from withholding tax, I have to now calculate my withholding tax or discuss my withholding tax. Then I'll come here and discuss my section 50B. I would say that now, Dev will be liable for interest withholding tax at 15%. Then I would say this withholding tax amounts to, I calculate there, amounts to 4875. Okay, I can give my 50B1. Let me go and talk about section 50B2. For the purpose of this text, is based on paid, for the purpose of this act, interest is deemed to be paid on the earlier of the date on which the interest is paid or becomes paid. Then I can state the date that the interest was paid on, they gave us the date there, on 29 February, yes, I remember, 2020, in terms of section what? In terms of section 50B2. Right, now you move on to this one, good people. What are you going to say as far as that section is concerned? You are going to say now, that this withholding tax, the withholding tax of 4875 is a final tax. Right, I don't see what to discuss there in your 4 there, but you can fit it in. You can still now go and discuss your section 50. See, there, it talks about which interest is paid liable. You will apply that section. You go 50D, we considered it. That is not, then you can go and apply also section 50E, withholding your tax and interest by pairs. Just say what is entailed there. You also can go to section 50F and touch on that one. The number of marks will determine how far you go. All right, so that was the case, good people. Now, what about if Dev has been in the Republic for 191 days? If Dev was in the Republic for 191 days, we're going to say now, Dev, the interest is it exempt? Is not exempt in terms of section 50, in terms of section 10(1)(h). Dev will be liable for interest on this amount. The whole amount of 32,500 will be included in his gross income, and then a portion of it in terms of section 10(1)(i). Dev being 38 years old, then we say 24,500 shall be exempt, right? So I am done with that one, good people. Our withholding tax, yeah, they took forever. They are covered, we covered them enough for you to go all the way until you write your final exams. You'll be discussing these things, good people. I hope you saw how we go about it. All right. So for now, I need to go to, there's still a lot of things that need to be covered. Yeah, this test is the longest of all. Yes?
Hello, Susan.
Yes, yeah, I can hear. Yeah, I can hear you. You can ask.
Yeah, please, can you go back? I was kicked out. Can you go back so that I can take a screenshot?
Okay. Here.
No. Back again. One step, I think. Try another one. Let's see.
Okay, I
Yes.
can send you this page
From
in
here.
PDF. Okay, from here.
Hmm.
So I move on to the next page.
Yes, the next page.
All right. We are now left with 2 things, people. We are left with capital gains and double tax agreement. Right, double tax agreement is not much. We can start with it next week, or we'll find time to do it. But it is always in the exam now. Here is the danger. It is always in the test. It is always in the exam. You will remind me to cover double tax agreement. And if you are not going to remind me to cover that, you will find out that you'll only be able to cover 30 marks in your test. Please, on double tax agreement, I'm begging you to remind me to cover it next class. Right, so I'm going to skip it for now. Then I go to another key topic.
Sorry, Sultan, can I ask something? Can you please go back?
Yes.
You said section 50D is not exempt. The interest
Yes, we
from
said
the
that
financial
now.
institution.
The interest is not exempt from withholding tax. Because why? It did not come from the government. It did not come from the bank. So because it was not exempt, that's why we had to go on and discuss the withholding tax implications. If it was going to be exempt in terms of section 50D, we're not going to go further and discuss anything. You get it?
Yes. No, sorry.
Okay.
I saw financial services institution then. Yeah, sorry, it's okay.
Okay. No, it didn't mean that it's a bank. All right, so
Sorry, Chirisani.
yes.
Can I ask something?
Yeah, it's fine.
With regard to the exemptions, isn't it exempt for a period of 183 days in aggregate? And
Yeah, this guy did not spend a period of more than 183 days. Do we agree?
yes,
He was in the Republic for how many days?
for 91 days.
Yes. So if he was in the period, okay, you were saying what? Oh, maybe you're right. Unless the person has been in the Republic. Okay, you're right there. Okay.
Yeah.
Unless the person was in the Republic for a period of more than, is it?
Yes.
Right. On that one, can you assume that Dave Mate was in the Republic for 191 days? Because if he's in the Republic for less than 183 days, we were going to exempt the whole of it. Hey, sorry about that one. I don't know if you'll be able to correct. But let's assume that Dave was in the Republic for 181 days so that it allows us to go ahead and discuss that. But the correct one there is the fact that Dave was in the Republic for 191 days. We were supposed to say the amount of local interest to be included in Dave's what? Taxable income. This. And then we exempt it in terms of this section. So people, may you please correct that section to make it maybe to say 191 days. Because the discussion that we did there, it is for one who was in the Republic for more than 183 days. Right? That was a good observation. And then you can also, on the other hand, say that assume Dave was in the Republic for a period of 81 days or for a period of 183 days, then you would say that the tax consequences would be as follows. So I want us to cover both because you don't know which one is waiting for you in the exam. The one that we did together, you rather write on top there that assume Dave was in the Republic for a period of 191 days. Then you show all those calculations. At the end of your answer, write that assume Dave was in the Republic for a period of less than 183 days. Then you say the tax consequences would be as follows. Are we together? If you have been in the Republic for less than 183 days, good people, the amount is, am I interpreting it correctly? Let's go to that section there and say 10.1. Any amount of interest which is received by or close to any person that is not a resident. Yes, before the unless part. The unless part is saying that unless you have been in the Republic for more than 183 days, or for at least 183 days, in that case, the interest is not going to be exempt. That will take us to that particular other section. All right. So that's how the two work. If someone was in the Republic for more than 183 days, that's when you consider your section 50B. That's when we are going to have the withholding tax consequences. For less than 183 days, that's when we exempt it in terms of section this. Right. So please correct that and make sure that you balance it nicely and you understand what we meant. All right. Now, I'm begging you to remind me to talk about double tax agreement next week, because our double tax agreements, good people, are always in our exam. But for now, this we can do in 30 minutes. But what is left for us cannot be done in 30 minutes. Given that we have got 1 hour, 30 minutes, I would prefer that we start on the greater part of our syllabus. Remind me on this one, good people. If you forget, then on the 13th, you're going to be in serious trouble. Remember, our next week's class is the last class before you write. So if I'm not reminded on this one, next week we are in big trouble. Okay, now let's move on to this one. Taxable capital gain. This one. Right. okay, remember I covered that one. Then I said this one, let's leave it for next week. It can be covered in the first 30 minutes, and then we can do our revision. But if you realize we are revising as we go along, so that even on the last day, if there's no revision, you can still go and pass. So now can we go and do the last learning unit? The last learning unit, it talks about taxable capital gains and assessed capital losses. Real people, let's dedicate today that we need to try and finish it, or we need to finish it. Even if it might mean overlapping a bit, people, you are going to be patient. You are going to be patient. I don't know if we are, okay, we are traveling for Easter, so right, if we don't have that class, that last class, yeah. Yeah. Okay. So let's move. Let's move. Taxable capital gain and assessed capital loss. This we are looking for natural persons. Okay. Right. We have already done a few things about capital gains for natural persons. Now, what is in the syllabus? These are the things that are in the syllabus. Our 8th schedule, paragraph 11, it talks about disposal and non-disposal. Right. So I'm not going to go to that one. It is quite straightforward. Disposal involves the following, right? What does disposal entail? I'm not going to go to that paragraph, but you have to go yourself. Disposal, it can mean that someone sold their asset, someone donated their asset, someone had their asset stolen, someone had their asset scrapped. Scrapped, it means that something is damaged beyond repair. If your car is a write-off, that event shall be treated as a disposal. Yeah. So it's something that they will tell you there. Also, here, events treated as disposals and acquisition, you will go also through those paragraphs, right? They are less important because they will be covered again in a learning unit 5. But visit it, just go through it. You are going to hear some things that we are going to cover here. Paragraph 13, in the 8th schedule, good people, it is going to talk about time of disposal. That's straightforward. On the day you sell that asset, that's the day you are deemed to have sold it. If your car is going to be write-off today, you are deemed to have disposed today. Paragraph 14, persons married in community of property. Now, when it comes to capital gains, which is our topic now, when it comes to capital gains tax, in terms of para 14, which is our 8th schedule, right? A capital gain or a loss, capital gain or loss is passive income. It being passive income, we are saying that now people married in community of property, people married in community of property, they share what? Share capital gain and losses equal. Are we together there? Right. So you read that, they are going to tell you exactly that. So capital gain, it's what? It's passive income. Capital loss, passive income. Then we come to here, good people. 8th schedule, paragraph 53. Personal use assets. Know your personal use assets. Can we go there? Personal use assets. is 8th schedule, para 53. What are personal use assets, good people? These are assets whose disposal do not trigger capital gains tax. Do we know them? E.g., disposal of furniture, right? Disposal of household effects, maybe your curtain, your pots, tables, TV, they're covered there, which is fine. Disposal of motor vehicles. If you say the motor vehicle SARS is not going to intervene and say, pay capital gains tax, you have disposed of the capital asset. No, that one is going to be referred to as a personal use asset, no capital gains tax consequences. Can we go to paragraph 8, schedule para 53, because these assets must be identified. 8th schedule, good people, para 53. We need to know all these personal use assets. Okay. Also here, you are going to have a boat with a length of less than 10 meters. It's a personal use asset. Aircraft with an empty mass of less than 450 kgs. Is it 450 or 4,500? 450 kgs. So now if you dispose the capital, the personal use assets, people, there shall be no capital gains tax consequences. You are not going to calculate anything in the exam. You just have to state that paragraph 53, personal use asset. You move on. Right, so now let's get to know our personal use assets. Are we there, good people? Let's assume it's there. We are there. Right, in terms of 8th schedule, paragraph 53. Hey, I know we might not be winning there on 8th schedule. You're right, you page on top there, people. Just look at the top of your Income Tax Act, you'll be seeing until you get to 8th schedule. If you see schedule 1, continue paging, because 8 is after 1. If you see 5, continue paging. If you see 9, that's when you have to page backwards. Okay, are we there on 8th schedule? People, if you don't see this, you rather tell me, because if you don't see it now in the exam, you're not going to see it also. And it's gonna be a problem. Are we there now?
Yes.
All right. It says personal use asset. A natural person or a special trust must disregard. Now, these personal use assets, they relate to natural person, not a company. Right, a natural person or a special trust must disregard. I want you to highlight disregard a capital gain or a capital loss determined in respect of the disposal of a personal use asset. So if you dispose a personal use asset, you realize the gain, disregard it, don't aggregate it. You realize the loss, disregard it. In other words, to avoid problems, you are not going to calculate anything. If it's a personal use asset, just state that this is a personal use asset and move on to the next asset. Because if you try to calculate it and say that the gain that I'm going to realize and the loss that I'm going to realize, at the end of the day, I am going to say disregarded in terms of 8th schedule, para 53. That gain might be wrong, and that will irritate the marker. Okay. A personal use asset is an asset of a natural person. I like that. It is an asset of a natural person. If a company is going to sell a furniture, it is not going to be what? a personal use asset. A personal use asset is an asset of a natural person or a special trust that is used mainly for purposes other than carrying on a trade. Now, this asset must not be used for carrying on a trade. Right. Personal use assets do not include, highlight that one. They do not include the following. So the items that are going to come after that, good people, are not personal use assets. If they are disposed in a question, please calculate the capital gain or capital loss and what aggregate it. Now, it does not include a coin made mainly from gold or platinum, of which the market value is mainly attributable to the material from which it is minted or cast. Kruger coins, I don't know what are they minted on, but Kruger coins are not personal use assets. You calculate gain or loss. Number two, immovable property. If you sell a primary residence, good people, we are going to calculate capital gain because it is not a personal use asset, even though you are using it not for carrying on a trade, but it has been executed in terms of X schedule, paragraph 53, 3B. Aircraft, the empty mass of which exceeds 450 kgs. If the empty mass exceeds 450 kg, that asset in question is not a personal use asset. But if it's less than, it is a personal use asset. A boat exceeding 10 meters in length. If the boat in question that has been sold exceeds 10 meters in length, it is not a personal use asset. You need to calculate capital gain. You need to calculate if there was a loss, capital loss. We move. A financial instrument. These are investments. If any fiduciary, usufruct, or other like interest in the value of which decreases over time. We cover this under donations tax. G, any contract in terms of which a person in return for payment of a premium is entitled to a policy benefits upon the happening of a certain event and includes any reinsurance policy in respect of such a contract, but exclude a short-term policy contemplated in Short-Term Insurance Act. Any short-term policy contemplated in Short-Term Insurance Act to the extent that it relates to any asset which is not a personal use asset, and any right or interest of whatever nature to or in such an asset envisaged in terms of A to H. For the purposes of subparagraph 2, an asset of a natural person or a special trust to whom an allowance is or was paid or payable in respect of the use of that asset for business purposes must be treated as being used mainly for purposes other than carrying on the trade. All right, good people. Our section, our 8th schedule, our para 53 must be tied to para 15. It has got a relationship with paragraph 15. So from there, I want us to go to paragraph 15. It has got some stories also to do with personal use asset. If you can check also, according to your act there, they said paragraph 53, then they come in to say paragraph 15. Paragraph 15, it says certain personal use assets. So highlight it or rather flag it in such a way that those two sections communicate to each other. All right. Right, let's go to that paragraph. They will tell us something interesting there. Now remember what we said. We said that those things that are listed in paragraph A to H could be A to I. They are not personal use assets, right? Meaning to say if they are disposed, we need to calculate capital gain. But go and find out in paragraph 15 what would happen. Now, those things that are listed, good people, which we say they are not personal use assets, your aircraft weighing more than 250 kgs, your Kruger coins, and some certain things there, we are going to hear about them in paragraph 15, what will happen. Right, paragraph 15 is something that is worth noting because it is tied to personal use assets. It says that now, personal use assets, bought and certain rights and interest. Okay, personal use assets, aircraft, bought and certain rights and interest. So it is selective. Let's go. A capital loss, highlight a capital loss in respect of the following assets of a person must be disregarded in determining the aggregate gain or aggregate capital loss of a person to the extent that the assets are used for the purposes other than the carrying on of a trade. Now, remember what we said. We said that if you've got a boat with a length of more than 10 meters, if you've got an aircraft that weighs more than what? 50 kg, these are not personal use assets. When they are disposed, they will trigger capital gains tax consequences. But then they say now, if these are disposed of and we calculate a gain and it results in a loss, this loss must be disregarded. You don't aggregate it to other gains and losses. You just look it aside, don't aggregate it. All right, an aircraft with an empty mass exceeding 40 kgs, if you try to calculate a gain, it results in a loss. Disregard that loss, don't aggregate it. A boat exceeding 10 meters in length, you get a gain, you get a loss, you disregard the loss. If you get a gain, you aggregate the gain. Any fiduciary usufruct or other similar interest, the value of which decreases over time. Any lease of immovable property. Right. Then you've got your E and F there, which are less important. I'm not going to cover them. Do we understand, good people, what this paragraph says? Because you'll be required to apply it. All right, hope so. Right, para 19, I'm not going to cover it. We'll cover it in test 4. And paragraph 56, disposal by a creditor of a debt owed by a connected person. Right one, that one you can cover it during your own spare time. I am now going to go on to where? I have to go on to this one. This one, we need it. Para 39, everyone must know it. Paragraph 39, everyone must know it. Can we go there? But what you're going to find there in paragraph 39, okay? Sorry. All right, no, let's not go there for now. We can cover this other paragraph. I see it was what? It is also included there. We will talk about it when we get to it there. Right, so let's not go there. Let's continue with our discussion of capital gains. We have to know first the personal use assets, that they do not trigger capital gains. If it's a personal use asset, you don't calculate anything. You state that is a personal use asset. Right. Now the details of our capital gains. Right. Now this is the tax on the gain made on disposal of a capital asset. Right. Now we have got what we call building blocks for capital gains, tax. In other words, we are saying that now, when do we calculate capital gains tax? When do we have a full set that will require us to calculate capital gains tax? Number one, good people, there must be an asset, not asset, but there must be a capital asset. There must be a capital asset. Number two, there must be disposal. That capital asset must have been disposed of. And when we talk about disposals, good people, we are talking about the sale of an asset. We are talking about the donation of that asset. We are talking about what? The asset being stolen. We are talking about what? The scrapping of an asset. Asset was written off. 2 building blocks. To the third one, there must be proceeds. Proceeds is what you receive in return for disposing of your capital asset. And it is like this. If the asset is sold, if you want it, the proceeds are going to communicate with disposal. You have disposal here, you have proceeds that side. You need to know these things. Otherwise, you're going to say, I couldn't calculate capital gains there because there was no proceeds. If the asset is sold, proceeds is going to be the selling price. If the asset is donated, what would be the proceeds? Market value. Market value of the asset on the day of donation. If the asset is stolen, it can be in two ways. If insured, if the asset that was stolen was insured, if insured, the proceeds are going to be what? Indemnity payment. What you receive from the insurance company is going to be deemed to be the selling price of your asset. If not insured, the proceeds shall be what? Proceeds shall be 0 rand. Right. So this will apply also to what? To scrapping. If your asset maybe is damaged beyond repair and you throw it away. So you need to know these things with people, because they are not going to be told that the selling price was this, the selling price was that. Sometimes they can say the asset was donated and might come out of the exempt saying that there was no capital gains there to calculate. Sharp. Number 4, this asset in question must have what? Base cost. Okay. Base cost, this is the cost of the asset. Asset for capital gains tax purposes. This is the cost of the asset for capital gains tax purposes. Right, for capital gains tax purposes, people, you might have bought your asset for an X amount of rands, but for the purposes of calculating our gain or loss, we might have to include a different cost for the purposes of calculating our capital gains. All right. Now, if you look at these building blocks, good people, there are sections that are attached to them. There are sections that are attached to them. Right. For instance, here, if we talk about an asset is described in a way. Paragraph 1. Paragraph 1, is it? Yes. Paragraph 1, let's get to paragraph 1. It will define to you what is an asset. And they are going to tell you that now, this is your paragraph 1, they will define to you what is an asset. Asset is going to exclude cash. They say cash is not an asset for capital gains tax purposes. If they say someone donated cash, we are not going to calculate any capital gains tax. Okay. So to make our life simple, let's look at the sections that apply. We have said that capital asset, we said is paragraph 1. It is defined there. And then we said this one will exclude cash. Remember, donating an asset will trigger capital gains tax. If someone donates cash, you are not going to calculate anything. You are going to say cash is not an asset as defined. That was a capital asset. Number 2, we have got disposal. Right. When we talk about disposals, good people, these disposals are defined in paragraph 11, in paragraph 12, in paragraph 12A, as well as in paragraph 9H. We can go through those paragraphs and find out what do we mean by disposal. And para 13 there to deal with your the time of disposal. So in tax people now at this level, they pay attention to those small things which we're just brushing on top at undergrad. Now, we haven't said that, good people. I said after proceeds, we need to talk about what? Disposal, we have said it. And here again on disposal, you might have to contact paragraph 22 there. It has got stories, especially for donated assets. Proceeds. There are sections that are going to deal with proceeds. Which sections are those? Which sections deal with proceeds, good people? There's para 35. And what's the other one? Paragraph 35 is going to be proceeds for assets that are sold. Remember, there are many ways of disposal. And then we have got paragraph, is it 36? For the assets that have been donated and other funny disposal there. No 36, but paragraph 38. Yes. For any other form of disposal. Paragraph 38, it is going to talk about disposal of assets by way of donation, consideration not measurable in money, and transactions between connected persons, not at arm's length. So I would like us to go to paragraph 38, all of us there. Otherwise, you are going to take the wrong proceeds. Can we go there? I'm simply going to read the heading. Okay. So paragraph 38, it is going to be our disposal by way of donation. If an asset is donated, our proceeds are going to be determined in terms of 38. Or if the asset is disposed of by consideration not measurable in money, maybe it was an exchange transaction, and transaction between connected persons, not at arm's length, or you were selling to a connected person. Our proceeds, we are not going to focus on how much did you sell your asset for, but the proceeds are going to be determined in terms of paragraph 38. So I'm going to read through paragraph 38 because it is something that we are going to see. Right. I'm not going to waste time here. It says subject to subparagraph 2 and paragraph 67, where a person disposes of an asset by means of a donation or for a consideration not measurable in money, or to a person who is a connected person, highlight connected person, in relation to that person for a consideration which does not reflect an arm's length price. The person who disposed of that asset must be treated as having disposed of that asset for an amount received or equal to market value. If your disposal, good people, it is going to be in terms of paragraph 38. You are going to use the market value as proceeds. If it is in terms of 35, you are going to use the selling price because 35 is clean. It simply say proceeds from disposal, normal disposal, not disposal that qualifies in terms of section 38. Remember now in the exam, these sections are not going to be there. The examiner will simply say someone sold an asset to a connected person for R1. The market value of this asset was this much. If we are going to take the R1, it will be wrong. In that case, you say, okay, these parties are connected persons. Therefore, in terms of paragraph 38, the process shall be market value. All right. We move on to another building block, which is the best cost. There are sections that deal with best cost coding. So all those sections that deal with best cost, they must be considered. They must be considered. Which sections deal with best cost? Which sections deal with best cost? Except for paragraph 20, you've got 20, you've got 26, you've got 27. Are we not given those sections here? Best cost. This one is not in the syllabus. Best cost. Paragraph 25, 26, 27. They address the best cost. Don't do this one, it's great. It is not in the syllabus. The other paragraphs there, we have got paragraph 20 and paragraph 20 and section 23C. 23C, it is for companies. You can pack it aside for now. And again, your best cost is going to be covered where? In, where are we? It is going to be covered in paragraph 30. That is the time apportionment best cost for assets that were acquired before the valuation date value. It is going to be covered there on paragraph 28. Market value will be provided. Paragraph 31, we need it. Paragraph 32, we need it. Best cost of identical assets, part disposal. Paragraph 33, debt substitution in the syllabus. Paragraph 34. Okay. So our best cost is very key there. Determining the best cost, it will tell the marker whether you know your capital gains tax in and out or not. But for the purposes of our best cost, people, the one that I will single out and discuss, it is going to be your paragraph. These ones are the ones that I want us to do. Paragraph 20, paragraph 26, paragraph 27. Now, these two paragraphs are for the assets acquired before, assets acquired before 1 October 2001. 1 October 2001 is the date in which the capital gains tax was introduced. Clearly. All right. Now, paragraph 20, it is going to give you the cost that must be capitalized to your best cost. Can we quickly go there? We have been to that paragraph before when we did our donations tax. It will tell you the cost that must be capitalized. I forgot another serious paragraph there. Paragraph 22. This is for what? Donated assets. All right, paragraph 20, good people, it will give you the best costs. It says that the best cost of an asset, it is going to be the cost of that asset plus those expenditures that are given there. Make sure you go through them because we have gone through them before. Then I want us to go to paragraph 22. Now, paragraph 22, it says that now for donated assets, a portion of capital, sorry, paragraph 22, it says that now a portion of donations tax paid by the donee, if the donee is going to pay any donation tax, shall be capitalized to best cost. So people, if you hear that the asset in question was donated, determine if the donee paid any donation tax. If the donee paid any donation tax, then a portion of the donation tax, it is going to be capitalized to best cost. And that portion is given by the formula Y is equal to M minus A divided by M times D. Can we go to paragraph 22 and then we get to know the components? Let's go there, good people. What is Y? What is M? What is A? What is D? What is Y, people? It's given there if you go to that paragraph. Unless if you're not there, you'll never know what your Y is. But if you are there, you're going to tell me that it represents the amount to be determined. So Y, it is the portion of the donation tax to be capitalized. Portion of donations tax to be capitalized. You only capitalize a portion of donation tax if the donee paid, the person who received that asset also paid some donation tax. Right. M is the market value of the asset. Market value of the asset. A, it represents the para 20 costs that have been taken into account. It represents all amounts allowed to be taken into account in determining the best cost of the asset in terms of this paragraph. So the things like selling price and any other cost that was capitalized before. And then our D represents the total amount of donation tax so payable. Total amount of donations tax payable. This is, we said that if the donee is the one who paid donation tax, SARS will allow you to increase the best cost with the portion of the donation tax that you paid. And that portion of the donation tax that you paid, it is going to be calculated using that formula. All right. So, all right. Okay, so allow me also to talk about best cost further. Right, best cost depends on when the asset was acquired. The when for capital gains tax, good people, if I say when and we're talking about capital gains, you should respond by saying before 1 October 2001 or after 1 October 2001. Right, that's the when for capital gains tax. This date represents the date on which the capital gains tax was introduced. Are we clear then? Now, the best cost for assets acquired before 1 October 2001. It is calculated as best cost is equal to the cost plus para 20 expenditures. When I say para 20 expenditures, I am talking about the expenditures of a capital nature to be capitalized to that cost. For instance, you might have bought, okay, this is not before, after. I'm starting with after because that's the easiest one. You just take the purchase price of that asset and you capitalize any expenditure of a capital nature. For instance, if it was a house, you capitalize any improvement that were made to that house. Maybe it's a swimming pool and stuff like that. And the other para 20 costs are going to be what? Your accountant's fee, your selling cost, etc. Easy. What about the best cost for assets acquired before 1 October 2001? Now, for this one, we say best cost is equal to valuation debt value plus para 20 expenditures on or after 1 October 2001. The para 20 expenditures should be very easy. Those are expenditures of a capital nature incurred on or after 1 October 2001. But we might have a challenge with this one, valuation debt value. How do we determine that one? All right, valuation debt value, VTV. This is valuation debt value. This is the value of pre-valuation debt assets. Pre-valuation debt assets as at 1 October 2001. If I say a pre-valuation debt asset, I'm talking about an asset that was acquired before the capital gains tax was introduced. Before the capital gains tax was introduced. That's a pre-valuation date asset. Right. Now, this VTV, it is determined in terms of paragraph 26 and para 27. Do you still remember these paragraphs from undergrad? Yes, our assets are going to be determined in the same, our VTV here, it is going to be determined in the same way. So our VTV, in terms of this paragraph, is either 1, market value on that date, 2, it could be our tab, 3, it can be determined in terms of the 20% rule. That is our VTV for people. Valuation debt value. Now, you will have to have these 3 amounts. This one and this one will be given in the exam, even if you check the paragraphs that have to do with this one, being paragraph 29 and paragraph 30. This one is para 29, this one is para 30. You don't need to go to these paragraphs because they say these amounts are going to be given to you. And the 20% rule, it is simply what? 20% of the difference between the proceeds and the para 20 cost incurred after. So I want you to go to your paragraph 26 for your 20% rule to find out how do I work out that 20% rule, right? Because you need to have these 3 amounts and we are going to choose one. How you choose that one is you are going to be directed by paragraph 26 and paragraph 27. But now, 1 October 2001, people, it's a long time ago, you realize that in most exams, they no longer bring the pre-valuation date asset. Because that asset, today, it'd be 21 years old. You wonder what kind of an asset can live that long. So we may be lucky, they may not bring the assets that were acquired before, they will simply bring the assets that were acquired after, and we shall use that base cost, determine the cost of an asset at your para 20 costs incurred after purchase. And if the asset in question was received by way of donation and the donee paid donation tax, work out your amount to be capitalized in terms of paragraph 22. All right. We continue with our capital gains tax. We need now to say capital gain or loss is calculated per asset. Calculated per asset. Then we need to say now that the aggregate gains or losses are then determined before allowing for number 1. First, it is going to be your annual exclusion of how much? Annual exclusion of 40,000. Where do we get this 40,000 in our act? Is it paragraph 5? If I say paragraph 5 like that, I'm referring to the 8th schedule. Yes, it is found there. Paragraph 5. We are not looking for the 146 instead. This is going to be our test 4. And before allowing for number 2, assessed capital loss brought forward. This is paragraph what? Which paragraph is that? Assessed capital loss for the previous year. This is paragraph 9. Assessed capital loss brought forward is coming from the previous year. Okay. And then after that, if you allow for this, then you are going to say taxable capital gain. Taxable capital gain at what? At 40%. This 40% people, you get it in paragraph 10. The usage of 40%, you must state that I'm getting from paragraph 10. So now let's look at this paragraph. Let's look at how we calculate capital gains. Calculation of capital gain or loss. The framework, remember I said we determine it per asset. You are going to say proceeds. Now your proceeds can be in terms of paragraph what? 35 or para 38. After that, good people, you are going to say less base cost. Our base cost is determined in terms of paragraph 20. Then you get your answer there. Right. Now, good people, there are some assets that have got what we call exclusions, specific exclusions. You will take into account the specific exclusions. Our specific exclusions are not many, there are only 2. Which ones do we know? And where do we find them? These exclusions, good people. Primary residence exclusion of 2 million, remember that one. If you sell a primary residence, the first 2 million is not going to be subject to capital gains tax. We need to take it out. And that primary residence exclusion, where do we find it? It is in paragraph what?
45.
45. 45, right? And then there's another one. For a small business, disposal of a small business, the exclusion is paragraph what?
57.
57. Right, do we know these amounts could be? This is an amount of 2 million, and this is an amount of what? 2.8, depending on the asset you are selling. If you are selling either a primary residence or a small business, remember to take out the exclusion before you get to that gain. This will be your gain or loss. Right, I look it there. This is going to be a gain or loss on the sale of that specific asset. Now, if the person is married in community of property, half of that gain or loss is the one that we are going to aggregate with other assets. That's how you calculate the gain or loss on the sale of an asset. Now, to go to taxable capital gain, good people. Taxable capital gain. We need to say, remember, this process, you are going to repeat it many times. You are going to repeat it many times. For each asset sold, we have to have this. For each asset sold, we need to have that. So when you are calculating the taxable capital gain, you are going to say now, gain or loss on asset 1. You come again here, gain or loss on asset 2. You continue now, depending on how many assets you sold. After that, you are going to get your what? Your aggregate gain or loss. Right. From there, you need to say less annual exclusion. Annual exclusion, of which we said it is an amount of 40,000 for you to get your net gain. Is it going to be net gain there? Let me see net gain. Capital assets, capital, no. Net gain for the person, the sum by which the aggregate capital gain for the person, first loss for the year exceeds. No, it's not net gain. This one, it'd be wrong to say that. You still have to take out your what? Less assessed capital loss brought forward. You need to take it out there. Thereafter, you then get your net gain. From your net gain, that's when you say taxable capital gain. Taxable capital gain at 40% if you've got a net gain. If you've got a net loss, you don't calculate 40% of that amount. All right, good people. Any questions so far? Are we able to calculate our capital gain? Are we able to do that? Okay. Right, for exclusions, we are still going to what? To elaborate on that. But let's go to the next one, whereby we are going to say rollovers. Right, when we talk about rollovers, we are talking about circumstances in which capital gain or loss is disregarded. There are certain circumstances, good people, in which we are going to calculate our capital gain, in which we are going to calculate our capital loss, but after getting it, we then look aside, disregard it. Then we disregard it. All right. Under what circumstances, good people? Number one, disposal to a spouse. Disposal to a spouse. It's like a donation, isn't it? Disposal to a spouse, section 9H. Section 9H. Let's go to section 9H there and find out. Now they say in terms of section 9HB, right? Sorry, it's 9HB. 9H is just ceasing to be a resident. 9HB. Now, in terms of this one, we are going to say if there's a disposal of an asset to a spouse, we are not going to have what? No capital gains tax consequences. If they told you that someone donated the property or the asset to a spouse, you are not going to calculate any capital gains tax. Can we go to section 9HB? Now, this is a section, it is no longer a paragraph. No longer a paragraph. So you will pay attention as to who are they selling to. If it's to your spouse, we are going to what? To disregard the capital gains tax. That's the only one that we are interested in. The other one for 65 and 66, we are going to look at that one when we do our taxation of companies, which is our tutorial letter 105, which is our next test. Okay, section now, it's a section could be for 9HB. It's not a paragraph. 9HB. Right, now in terms of 9HB, they say a person.
Tulisani, are you sharing your screen?
I know. I said let's go to section 9HB then. I'm not sharing my screen. What is still on my screen there is that. Right. Now, here is another way in which good people, our disposals are not going to trigger capital gains tax. Okay, I remember when we did our donations, good people, this section was covered. We went through that section, transfer of assets between spouse, they will not trigger any capital gains tax. We refer to it as a rollover. All right, now what you realize, good people, is we still have to look at this in our next class, especially, okay, I'm giving you a homework. The class is not done yet though, but here's the thing. Primary residence exclusion. We have agreed that it is an amount of what? 2 million. But if that property in question was used for business and for residential purposes, we need to apportion our gain into the one that relates to the business. That one is not going to have any primary residence exclusion. It was not used as a primary residence. Or if this property that we are selling, we once used it as a primary residence, then at some point in time, we rented it out. That portion in which the property was rented out must be adjusted. So this is going to be our next class. We are going to do that one in our next class. But people, you go through those sections. This one is not in the syllabus. Go through those paragraphs. Read. Read. It is going to do with apportionment of our primary residence, but I'm going to demonstrate it somehow. And then again, I want you to go and read 50, this one, 57. This is other exclusion, primary residence exclusion. Go and read that paragraph. There are some conditions to be met when someone disposes of a small business corporation for them to enjoy a certain exclusion. Go and read. Right, they are going to give you some stories there and understand them before I explain them, so that now if you go and understand them, read on your own slowly and understand them, it is going to make our life very easy. It is going to make our life very easy. All right, let's do questions for today. There is a question, I've sent it. We'll do that question. Right, I think I'll end up appointing a class prefect here. For next week, we are going to look at our section 9H. This is going to be change of residence. We are then going to look at our double tax agreement. We will look at, we are going to look at primary residence exclusion. Then our syllabus is going to be done. Right. Here, to be honest, good people, for us to be where we're supposed to be, we needed another class before the one for that one. So you go and read that one. Remind me these sections, good people, because if they are not going to be covered there, it is going to be a big problem. A big problem. A big problem. I only remember when I'm seeing those things in the question. Right, we are going to do the one that I put first there on top, then followed by the next one. So the first one that we have there is the one that we are going to do first. We need to identify what is it that we covered today, and we need to apply the rules of what we covered today. All right, please, someone should remind us on this. Failure to do so will suffer the consequences in the test as well as in the exam. I also can forget. All right, we have to do questions now. Open that question that I gave you. Open that question or that I gave you, the first one. Okay, the first one, I'll also share it from this side. All right, so what things that we covered. Okay. VET done, we did that one. This one, we did it. The Nguni Trust, we did it. Part D, it was never done. So we are going to do part D, good people. Right, part D, and our required there is going to be part D. All right. So we go through that. Let's go through that. Now it says Melody Sunshine is 50 years old. So the age of a taxpayer, people, will always have implications. Is 50 years old and worked as a financial advisor at Blue Ivy Investment, Pty, private company, for the past 25 years, up until his retirement on 30 September. Melody is married out of community of property. It plays a role. Investment income is not going to be shared equally. Passive income like capital gains is not going to be shared equally. So those are the things that you're supposed to be seeing as a tax student. What is the implication of this statement? All right, we move on. Person is not married in community of property, is married out of community of property to Bob Sunshine. So you have to know who is Bob. Bob is a spouse, because we do have a lot of stories that have to do with spouse. If a donation is made to a spouse, no donation tax consequences. If a disposal of an asset is made to a spouse, no capital gains tax consequences. So don't see that one as extra information. It plays a big role. The husband is 52 years old. Also take note of the age there. It will play a role. They can change and say, calculate the taxable income for Bob. Now, they are both South African residents. That's key there. So we are not going to have to apply Section 9 source of income does not apply to residents. Residents are taxed on the worldwide income. Now, after her retirement, Melody decided that she wants to sell a portion of her own asset portfolio, and use the money from the sale of her assets to enroll at a botany, that is the study of plants course. One of your lifelong passion is to become a botanist. The following transactions took place during the 2020 year of assessment. All right, there is one thing that I forgot, but I'm going to cover here. I forgot to take you through our paragraph 39. If it's going to apply here, we are going to go through it. All right. Now it says asset. You've got a motor car, not number one. It was purchased on that date. The cost price was that. The market value was that. The selling date was that. It was sold for 200,000. And I hope by now we know the story of motor cars. Are we going to calculate capital gains on the sale of that motor car, good people? If ever we are asked to calculate capital gain, are we going to calculate the capital gain?
No.
Personal use asset, isn't it?
Yes.
Okay, we move on. A flat in market. Oh. Okay, no, we go to note number one. They say Melody decided that it would be more practical to buy yourself a utility vehicle, as she often travels on gravel road in search of rare plant species as part of her botany. Therefore, she decided to sell a motor car to her cousin, Poppy, for 200,000. We are not going to calculate anything here. A motor car is a personal use asset that's used for private purposes. We move on to number two, a flat in market. Note number two, it was purchased 5 June 2013 at a cost price of 100,000 at 1 million. Market value on the selling debt, so it was sold. Market value on the selling debt 1.2. Selling debt, and then selling price nothing. Maybe it wasn't sold. We read there. Melody has been experiencing some health problems, and as a result, she decided to donate the flat in market to her husband. Remember, donation is a disposal of an asset. Assume that the donation was not made with the sole or main purpose of reducing or postponement or avoiding tax. Therefore, section 7.2 is not applicable to this donation. So if I may ask you, good people, are we going to calculate, if you're asked to calculate capital gains tax consequences on that flat, what are you going to do there? Are we going to calculate, or we are going to say some stories?
We're saying donation to a spouse.
Donation to a spouse. The flat was disposed to a spouse, isn't it? Now, in terms of section 9H, no capital gains tax consequences. If they will say calculate the capital gains tax, I would say no capital gains tax is to be calculated. Disposal to a spouse, rollover, section 9HB, transfer of asset to a spouse. If they say calculate the donations tax, I'm going to say section 56(1)B there. Not donation tax is payable as it is a disposal to a spouse. All right, we go back. A flat in Palito, note number 3. Purchase date, that cost price. Market value on the selling date, 700. Selling date is given. Selling price is given. That flat was sold. Note number 3. Since the property market in Palito has been stagnant for the past few years, Melody believes that the flat that she bought is no longer a worthwhile investment. Melody decided to sell the flat in Palito to her brother. That plays a role. To her brother, Sam Sunset. Now look at this. This is a disposal to a connected person. A brother is a connected person, isn't it? The market value was 1.2, the market value was 700, but it was only sold to the brother for 500. Which one are we going to take as our selling price?
The market
The brother
value.
is a connected person. Market values. We are going to apply paragraph 38 as our process, not 35, because this is a disposal by way of, it's kind of a donation, it's to a connected person. Do you see that? It's a connected person. One of the headings there, paragraph 38, they say disposals to connected persons. We use market values. Okay. Then they go on to say, some said, since he loved spending time at the beach, Melot decided to repair the old and damaged laminated wood countertops and add a built-in braai on the enclosed patio before transferring ownership of the flat to Sam. The countertops cost 25,000. These ones were replacement, were actually repaired. And the built-in braai cost 40,000. That one is an improvement. This cost we are going to capitalize in terms of para 20. This one we do not capitalize because it is simply a repair cost. You are just restoring your asset to condition it was before. The work on the flat was completed on the 2nd of October 2019. The sale of the flat was registered in Sam's name on 8 October 2020. Number 4. Number 4, there we have got a boat, luxury boat, purchased on that date at that cost, market value at the time we sold it, selling price, okay, selling date, and the selling price. It's a boat. Be careful. Melot sold a boat, which is 12 meters long. So that boat is not a personal use asset because the length is more than 10 meters. To your friend, Daisy. A friend is not a connected person, people, right? A friend is not a connected person. Don't say it's a disposal to a friend. A friend is a connected person. No, read your connected person's definitions clearly. A friend is not a connected person. All right. So it was sold. Since Melody spent most of her time focusing on her botanic business and did not have much time to use the boat anymore, Melody had only used the boat for private purposes. But it's not going to be deemed to be a personal use asset. Right, Melody invested in shares. I gave you that as the homework last time. I hope you did that question. Right, required D. D, calculate the effect that transaction 1 to 4 will have on Melody Sunshine's taxable income for the 2020 year of assessment. Provide reasons or reference to relevant legislation in the Income Tax Act should any amount and not to be included in the calculation of Melody's taxable income. Assume Melody Sunshine had an assessed capital loss of 35,000 brought forward from the 2020 year of assessment. Ignore donations tax consequences, 11 marks. All right. So what we are seeing, good people, here, it is simple, the disposals of assets. It's all clear to us. Now, so now they are testing us on capital gains tax. So the second taxable income, remember 40% of the gain made on the sale of a capital asset is supposed to be included in the person's taxable income. So we are going to calculate Melody's taxable income, taxable capital gain. And then we say this is what is going to be included in their taxable income. Now, good people, this is how it's going to be done. You are going to start on a fresh page. You have 2 columns like this. In this column, we do our calculations. And then in that column, we are going to put our gain or losses to be aggregated. And we are going to move asset by asset until we get there. Asset by asset until we get there. All right. We agreed that capital gains is calculated per assets. After that, you put together the gains and losses. So that's the tax income. Okay, let's start with people. What is asset number one? Asset number one.
It's motor car.
Disposal of motor car. How do we calculate the gain or loss here for people? We agreed that this is a personal use asset. Then you say paragraph what?
53.
Okay. Number two. Disposal of a flat. Disposal of a flat in right. So it was disposed. Let's go to number two. Melody has been experiencing some health problems, and as a result, she decided to donate the flat in Market to her husband, Bob. How do we calculate a capital gain on the disposal of a flat to a spouse?
Section
right. With a section 9 HB, no capital gains tax consequences. Are we together, people? Transfer of the property to a spouse does not trigger any capital gains. It's a rollover. Number three, disposal of a flat in Palito. Right, what about that flat? How was it disposed of? Note number three. Now, this is the one that was sold to a brother. Do we agree?
Yes.
Okay. Now, give me the correct process. A brother is a connected person. Our process is going to be determined in terms of section 35 or in terms of section 38. The flat was sold for 500,000 when it had a market value of 700,000. And this flat was sold to a brother. Proceeds.
38.
35 or 38?
38.
38. Now, if your process are going to be determined in terms of paragraph 38, good people, we are going to use the market value. We are using the market value because this was a disposal to a brother. If you go and look at the heading for paragraph 38, it says disposal by way of a donation, disposal to connected persons, disposal in which the proceeds are not measurable in what? In money. How much is our market value there? 700,000, isn't it? Right, less base cost. Now, our base cost, the asset was acquired after 1 October. So our base cost is simply going to be the cost price of that flat plus our paragraph 20 costs. These are costs of a capital nature incurred after date of purchase. That flat was bought for how much, good people? It was bought for 700,000. Do we agree?
Yes.
And then do we have any expenditure of a capital nature that we have to capitalize?
Yes, not number 3.
Not number 3. There were repairs costs. Do we capitalize repairs? Do we capitalize repairs? No.
No.
They are not capital in nature. You are simply restoring your asset to the condition it was before. What about the built-in price that was added? Do we capitalize the cost?
Yes.
40,000. 740,000 there. So here there was a loss of how much? Do we agree?
20,000.
Capital loss. Now, do I aggregate it to that side, good people?
No, you just
Remember, capital, yes. Now, the reason why we are disregarding it is because of the application of paragraph 39. Can we go to paragraph 39? Now, paragraph 39 is going to tell you that now, if you sell an asset to a connected person, and that sale actually leads to a loss, that loss must be disregarded, and it is going to be set off against future capital gains or losses made to that very same person. Let's go to paragraph 39, good people. Right, it's a common feature in our exam, we need to know it. So whenever there's a disposal to a connected person, people, there are some things that must come to your mind. Number one, which proceeds do I use? Number two, what if it results in a loss? If it results in a loss, you go to paragraph what? 39. So I'm going to read a few parts there, then you finish during your spare time. Now it says, capital losses, are we there on 8th schedule, paragraph 39? It says capital losses determined in respect of disposal of certain, in respect of disposal to certain connected person. Right, I'm not going to read paragraph 39.1. For your definition, I'll go straight to where the principle is. That is 39.2. It says a person's capital loss, you highlight loss, which is disregarded in terms of subparagraph 1. No, I have to read 1. A person must, when determining the aggregate capital gain or aggregate capital loss of that person, disregard, highlight disregard, any capital loss determined in respect of a disposal of an asset to any person who was a connected person in relation to that person. Like for instance here, we disposed a capital asset. This person disposed of a capital asset to a brother. A brother is a what? A connected person. And that disposal resulted in a loss. So this loss is going to be disregarded. So you state there that paragraph 39, disregard the loss. Don't aggregate it, good people. Now, I want you now during your spare time to go through the whole of paragraph 39. Okay, now let's continue to the last asset. Last asset, asset number 4. Now, asset number 4, it is going to be, not 4, is it 4? Yes, number 4, yes. A luxury port. Luxury port. Before you calculate, determine if it's a personal use asset or not. In this case, it is not, because it has got a mass of what? A length of more than 10 meters. So let's move. Proceeds. Less base cost. Let's calculate. Right, the proceeds to use, 38 or 35. It was sold a luxury port to a friend. A friend is not a connected person, good people. So we are going to use the selling price. Are we together? A friend is not a connected person, so we are going to use the actual selling price of 755,000. Base cost, how much was it bought for? It was bought for 750,000. We have got a gain of 5,000 that we need to aggregate there. Are we together? Are we together with you?
Yeah, well, yes.
Yes. So now, if this turned out to be a loss, we are going to disregard this loss in terms of paragraph 15. Okay. Now we are done with all our assets. What is the next thing, good people? I gave you the framework for capital gains, that you calculate the gain or loss per asset. Thereafter, you need to aggregate all the gains and losses. This becomes our aggregate gain. It's a gain. This being an aggregate gain, how do we proceed? What is the next thing? Your framework for capital gains, good people? Or now,
I think there is an assessed loss somewhere.
yeah, that one will come last. Before the assessed loss, what do we have? Yes, so that order there, you need to be careful. You don't put your assessed loss before annual exclusion, is it? Are we together, people? Annual exclusion should come first. Our annual exclusion is 40,000, but because there we have got 5,000, we shall limit it to 5,000. Do we agree, good people? Good people? Are we agreeing on that one?
Yes.
Yes.
All right, then we move on now. Now it is then that we are going to consider what here we say dash. Thus, when we consider assessed capital loss. How much was it?
35,000.
$35,000. It is a loss. Thereafter, we are going to have what this assessed loss is going to be brought forward to the following year. Okay, people. So, any questions on this one? Do we have any questions on this one?
Hey, Tulisani, where do we get the 35,000?
You say? This 5,000 is the aggregate from there. We consider that which is nothing there.
35,000.
Oh, is it how much is the assessed loss? I remember seeing that 5,000. Was it 30?
35,000.
Assessed capital loss. Where is it? Is it in the required?
Given into the information.
Log number.
Required.
Oh, yeah, and the required.
Oh, okay. Thank you.
All right, people. So don't forget to remind me the things that I said you should remind me, because we can have serious problems. I'll also share that on the group there, so that now if we forget, we can refer to that particular item there. All right, let's end it here for today, good people. Let's end it here
Tulani,
for
can you please, Tulani, can you please
Yes.
move up to point number 3? I just want to check something.
Oh, okay, this one. Remember your homework. Your homework is to go through paragraph 39 and understand why I did not aggregate the loss that side. All right. So we will end it here. Right now, what we are going to do is there is another one that I shared there in the group. It is actually that other one. I don't see it. There's another one that I shared in our group, right? So that one will require you to do which is required. Your homework there, it is going to, the second one that I gave you, please go and do attempt. It has got some apportionment there. Go and attempt attempt number 2. You can't attempt that one. We still have to do our our section 9C. All right. So let's end it here, people. If you've got a question, you can ask. But here we needed an additional class, guys. If you don't have a problem, I think we should discuss when are we going to have our other class before that other one. So that the last class will be reserved for vision. But if you are brave, it's okay. That class, you can just have it as part of going through our material. Then we'll see what to do. Okay, someone is suggesting Wednesday. All right, Wednesday then. 6:30 Wednesday. Let's remind each other. 6:30 Wednesday. Let's come and finish our syllabus. It should be 6:30 because during the week I arrive late these days. Wednesday 6:30. Let's come and finish those things. We'll remind each other also on Tuesday. So Wednesday, 6:30, let's have a class. We finish what we need to finish so that we leave our last class for revision. All right. But before you come,
The next coming Wednesday.
This one. If you're
This
going
one.
to.
All right. Okay, sure.
Before you come for class on Wednesday, make sure that you have covered these paragraphs. Right. Remember, they are the one that talk about the apportionment of the primary residence exclusion. There, where are those ones? These ones we covered. Where are those ones? Proceeds we find primary residence. You should have covered those. Don't do this one, it is not in the syllabus. And also, all these years here, they should have been covered. Especially this one, not it. And also, you should have covered your section 9H. All right, thank you. Let's end it here.